So I believe we are live. I believe we are live. Let me check the audio video first and then we can start off. So I believe we are live. Okay. So audio video seems good. Okay, so hello everybody and welcome to this English CA Final DT Power Batch applicable for September and January 26 attempt. How you all are doing? Just first of all give an overview of that. Meanwhile, let me brief you out what we had studied yesterday so that we can start off with today's session in more beautiful and energetic manner. We have people joining with us. Good morning to all of you. Yesterday, towards the end of the session, we started off with the chapter capital gain. Right away, starting from section 45.1, which states what the charging section is. Section 45.1 is the charging section which states any gain arising from transfer of capital asset shall be taxable under that capital gain in the year in which transfer took place. The definition includes the meaning of transfer, which implies, sir, any kind of asset is a capital asset. Any kind of asset is a capital asset. But, sir, we have to exclude four things from this. Any stock in trade held for business has to be excluded. Any kind of asset which is movable and personal has to be excluded from the definition of transfer. Any kind of rural agriculture land is to be excluded. And, sir, any kind of gold deposit bonds are to be excluded. But, sir, remember, any kind of jewelry, drawing, painting, sculpture, archaeological collection. They might be movable personal, but they have to be included in the definition of the capital asset. Apart from that, any securities held by FII or any ULIP to which exemption under section 1010D does not apply also imply capital asset. This was the definition of capital asset we had studied. Later on, we came to rural agriculture land. We had talked about that whatever the municipal limits are is the urban area. And if the population is 10,000, then that area is only the urban area. But if the population increases from 10,000 to 1 lakh rupees, then 1 lakh people, then area beyond the municipal limits up to 2 kilometers shall also be urban area. If the population exceeds 10 or 1 lakh, but is up to 10 lakh, then in that case, area beyond municipal limits up to 6 kilometer area shall also be urban area. Also, we had talked about that if population exceeds 10 lakh, then in that case, area beyond 8 kilometers of area of municipal limits shall also be urban area, rest all will be rural. Then we came on to the definition of the transfer, which talked about sale, exchange, relinquishment. It talked about compulsory acquisition. It talked about conversion. It talked about extinguishment of capital asset. It talked about, sir, allowing possession of immovable property. It talked about redemption of zero coupon bond. Then we came on to a very important topic, which was period of holding. Sir, period of holding. How much asset should be held to make it long term? Otherwise, it shall become short term. That period of holding concept was changed during the year. So for that matter, what thing relevant was? What important factor was, sir? We have to remember the provisions that were existing earlier, and we must remember the newer provisions also. So any listed securities other than units of business trust listed on recognized stock exchange plus equity oriented mutual fund plus units of UTI plus units of business trust shall be held for more than 1 year to make them long term. Otherwise, they shall become short term. Sir, any kind of shares, any kind of units or any kind of immovable property shall be held for more than 2 years to make it long term. Otherwise, they shall become short term. And any other asset like gold, debt oriented mutual fund shall be held for at least 3 years. Then only they'll become long term. Otherwise, they'll become short term. But this provision was changed during the year. This provision was changed during the year, and sir, Nimotai just changed it and said listed equity shares, listed securities, any listed security shall be held for 1 year. Therefore, earlier when business trust was seen for 3 years, now it has to be seen for 1 year only. And any other asset, be it gold, be it debt oriented mutual fund, everything now is to be seen for 2 years. We do not have a concept of 3 years period of holding with effect from 23rd July. After that, we came on to computation portion. So we talked about the format. That format has to be followed while computation of capital gain. Format is a full value of consideration minus transfer expenses. That will give us net consideration. Cost of acquisition is to be reduced. Cost of improvement is to be reduced. And so that will give us capital gain. After arriving at capital gain, we shall reduce exemptions under section 54. Then we will get the taxable capital gain. For this whole purpose, whenever we are calculating full value of consideration, we must remember that whatever price that we are receiving via selling the asset, then it is the full value of consideration. But in three cases, full value of consideration is taken separately. For example, if we are selling any immovable property, then we have to check the stamp duty value. If stamp duty value exceeds 110% consideration, then in that case, stamp duty value shall be taken as consideration. Otherwise, such consideration is only the consideration. Sir, if we are not satisfied with the SDV, then we can refer our case to valuation officer. If SDV determined by valuation officer is higher than original SDV, then we can ignore it. If SDV determined by the valuation officer is lower than the earlier determined SDV, then we can take the lower SDV. SDV on the date of agreement or SDV on the date of registration. What to be taken? Provision says if any money has been received on the date of agreement via account pay check, account pay demand of electronic clearing system, then SDV on the date of agreement to be taken, otherwise SDV on the date of registration to be taken. Then we came on to section 50 CA, which said any kind of unlisted equity shares, if sold, then higher of fair market value or sales price shall be taken as full value of consideration, but this provision does not apply to the company whose board of directors has been suspended. At last, we came on to 50D, which said if you are selling any asset whose full value of consideration cannot be determined, then in that case, fair market value shall become full value of consideration. We came on to next topic, which was cost of acquisition. Sir, what cost of acquisition said? Sir, cost of acquisition was important because what price should be reduced from the capital gain computation. So first of all, whatever price that you have paid to acquire that asset has to be added. Whatever price that you have paid to obtain the clear title of that asset shall also be added. Also, sir, if you have paid any interest on loan taken for acquisition of that asset shall also be reduced. But we must remember that any interest paid shall not be reduced if such interest has been taken as deduction under section 24B in house property, or such deduction has been taken under section 80EE or 80EA. In that case, such interest shall not be taken as cost of acquisition. Then we came to special cases of cost of acquisition, which were if I had received asset free of cost, then cost of acquisition of previous owner shall be taken. If I have certain intangible assets, then what to do? If intangible assets are self-generated, then cost of acquisition will be nil. But if intangible assets are in acquired from somewhere, then in that case, cost of acquisition shall become the purchase price that we have paid. If any asset is acquired prior to 1st April 2001, then whatever the fair market value was on 1st April 2001 shall be taken as cost of acquisition. But in case of immovable property, fair market value cannot exceed the stamp duty value. Also, so this fair market value benefit was not given for intangible assets. So if we had any depreciable assets in our block, then whatever the WDV was shall become our cost of acquisition. In case of bonus shares, sir, bonus shares if acquired prior to 1st April 2001, then fair market value shall be taken as full value of consideration or full cost of acquisition. If acquired later than 1st April 2001, then cost of acquisition for bonus share will be completely nil. If such bonus shares are listed on recognized stock exchange, then we still get benefit of 31st Jan 2018's fair market value. If we are taking any right shares, if we are having any right shares, then whatever purchase price we pay during the acquisition of the right shares, then that shall become our cost of acquisition. Also, if we renounce that right, then whatever renouncement money that we get shall become the short-term capital gain, and whoever person buys such renounced shares has to have cost of acquisition as the renouncement price paid and price paid to the company. So if I buy any kind of sweat equity shares, then whatever the fair market value is on the date of exercising the option shall become the cost of acquisition. At last, we studied in case of demerger. So whatever the net assets have been taken by the resulting company, that's resultant that the percentage of net assets shall become the percentage of share price in case of resulting company, and similar share price what has become of resulting company shall be reduced from original demerged company. Just after completing this, we came on to the topic that was indexation. Sir, we talked about if any of the asset is transferred prior to 23rd July 2023, 24, sorry. If any of the asset is transferred prior to 23rd July 24, then in that case, instead of taking cost of acquisition, instead of taking cost of improvement, you will be taking index cost of acquisition or you will be taking index cost of improvement. For indexation, you have to divide by cost of inflation index of previous year 21 previous year of acquisition. You have to multiply it by CII, cost of inflation index of the year of transfer. In case you have acquired asset prior to 1st April 2001, then you have to take FMV as on 1st April 2021 or cost whichever is higher, and you have to divide it by 100 multiplied by the CII of year of transfer. In case of any immovable property, in case of any immovable property, then you have to see whether SDV of that property is available. If stamp duty value is available, then FMV cannot exceed SDV. Any improvement done prior to 1st April 2001 shall be completely ignored. We have a list of CIA. Also, we must remember that any securities, any share, any asset transferred after 1st April, for 23rd July 2024 will not give us any indexation benefit. No indexation benefit whatsoever shall be given on the assets transferred on or after 23rd July 2024. This is what we had studied yesterday. So, were you able to recall what we had studied yesterday? Just tell me this thing so that we can continue further. Best in the world. Hello, sir. Good morning. Good morning, best in the world. Were you able to recall what we had studied yesterday? Yes, sir. It was very much convenient for us to recall whatever we had studied in just 10 minutes. Just imagine. It took us 2 hours to understand those provisions and just a 10 minutes to recall those provisions. Sir, continuing further, we have first proviso with us. What first proviso says? Sir, for example, we have, Sir, Mr. Joseph Tribbiani. If we have Mr. Joseph Tribbiani with us, Joseph Tribbiani is very bullish about Indian stock market. Therefore, he invested rupees 10,000 US dollar. He invested rupees 10,000 US dollar on 1st April 2024. It was 2016. At that time, rate of dollar was 65. Therefore, he invested 6,50,000 rupees in India's Rahul Private Limited. He invested in India's Rahul Private Limited. Joseph Tribbiani invested 10,000 US dollar. At that time, exchange rate was 65. He invested 650 into Rahul Private Limited. Okay, sir, we got this. Years passed. This share price, these shares increase. And as on 1st April 2024, share price shot up to 12 lakh rupees. This was the date when Joseph Tribbiani wanted to sell these shares. He sold it. He sold such shares. It was apparent that Joseph Tribbiani has capital gain of 5,50,000 rupees. It was apparent that Joseph Tribbiani would have had a capital gain of 550. Nemotai just came and asked for taxes. Taxes. Nemotai came and asked for taxes. Nirmala Sitaraman ji just came and asked for taxes. Joey had actually no issue paying the taxes in India. But what the case was, when he took this money back to USA, he found out that exchange rate was 100 rupees now. $1 was equals to 100 rupees. Now, when he took back money from India, the actual dollar that he took out was 12,000 only. He came with $10,000. He is taking back $12,000. Ultimately, he has only the benefit of 20%. Are you able to catch what I am trying to say? If we are considering capital gain in rupees, then capital gain is 5,50,000 rupees. But sir, if we are calculating capital gain in dollar, then capital gain is only 20%, that is $2,000 only. And basic reason is because whatever the share appreciation has taken place, this has been countered. This has been countered by rupee depreciation. Therefore, actual gain to Joseph Tribbiani is just $2,000. For that matter, what can be done? What can be done? It would be unfair to charge five. It would be unfair to charge 550 as capital gain to Mr. Joseph Tribbiani. It would be unfair now. So how to counter that? How to counter that? For that matter, came first proviso to section 48. And a very beautiful benefit. It is a very beautiful benefit given to everybody. What this provision says? This provision says, if any non-resident foreign company invest in securities of India. Remember, no benefit on unlisted securities. This benefit is only available if they invest in unlisted securities. This benefit is only available if they invest unlisted securities. If they invest in listed securities, then no benefit. Remember, sir, if any of the non-resident invest in unlisted securities of India, then in that case, sir, then capital gain shall be computed in foreign currency. Whatever the capital gain computation is shall be done in foreign currency. Sir, for example, full value of consideration in our case was 12 lakh rupees. Cost of acquisition was 6 lakh 50,000 rupees. Now this full value of consideration shall be converted into foreign currency. And sir, what rate shall be used? Sir, rate on the date of transfer. Date of transfer, whatever the average exchange rate was, average of buying and selling rate shall be used. In our case, it was 100. So full value of consideration shall be 12,000 US dollar. 12,000 US dollar. Cost of acquisition shall be converted with a rate on acquisition average rate. In our case, it turns out to be 10,000 US dollar. In our case, it was 65. So whatever the cost of acquisition was, it was 10,000 US dollar. Correct? Capital gain amounts to rupees 2,000. Now this capital gain shall be converted back to rupees via date of transfer. Buying rate shall be used to convert this capital gain. So for conversion of sales consideration, average rate on the date of sale. For cost of acquisition, average rate on the date of acquisition. And sir, for converting the capital gain, average rate, sir, buying rate on the date of transfer shall be used. So if I use 100, then in that case, sir, capital gain will turn out to be, actual capital gain will turn out to be 2 lakh only. So out of this 5 lakh, 5 lakh 50,000, 2 lakh is only taxable in India. 3.5 lakh is actually on account of foreign exchange fluctuations. It is only on account of foreign exchange fluctuations. This is not the gain. Okay, sir, we got this point. So third proviso says the similar thing, that if you have any listed securities, then on listed securities, no indexation will be allowed. Also, if you have any securities on which non-resident is taking this first proviso benefit, on such securities also, on listed securities also, such first proviso benefit is not available. You can skip this portion. Seventh proviso, what it says? Seventh proviso says, if you have any kind of STT paid, if you buy any securities or if you sell any securities, sir, whatever security transaction tax you pay, it is a dead expense. You can never reduce such STT paid from your full value of consideration. You can never add such STT in your cost of acquisition. You can never claim such STT as your transfer expenses. That is completely dead expense. You cannot claim any deduction on such STT paid. So we got this point to the fullest. So where we are right now. First, let's have a overview. Sir, we started off with basic definitions. Then we came on to computation part. And in that computation part, firstly, we did basic portion. Then we came on to how to compute full value of consideration. 50C, 50CA, 50D we studied. After sales consideration, we came on to cost of acquisition, where we had multiple options. If we acquired asset free of cost, if we acquired intangible asset, if we acquired bonus share, if we acquired right shares, we did multiple things. And then we came on to provisos. What provisos are indexation when available or not? Or if non-resident invests in unlisted securities of India, then what to do? In such cases, we studied the provisos. Now we have to study the special cases. And what are these special cases? This is important question. This is an area from which you might see question in your exams. So for that matter, you must be very active while understanding these provisions. Okay, sir, we are already active. We are already active. No issue whatsoever. Exceptions to 45(1). Acha, you all are awake now? You all are awake now? My audio, video, everything clear to you all? My audio, video, everything, my words clear to your brain? Whether my audio is able to break through your ear and get into your brain? Sir, absolutely clear. Sir, first of all, we have four special cases. And what are those special cases? Sir, while studying charging section, we read a point that any gain arising from transfer of capital asset shall be taxable under that capital gain in the year in which transfer take place. Charging section says that whenever transfer takes place, we are going to charge capital gain. Whenever transfer takes place, we are going to charge capital gain. This is what charging section says. Sir, for example, we have destruction of capital asset. Destruction amounts to transfer. But in that case, charging capital gain in the year of destruction would be wrong now. Charging capital gain, charging capital gain would be wrong now. So for that matter, if there is destruction of capital asset, capital gain will not be charged in the year in which asset is destroyed. It will be charged in the year in which insurance money is received. Sir, for example, if this was me, this was Rahul. Rahul and Mrs. Rahul had went to Sweden just for a trip. They had gone to Sweden. At the back end, their house was set on fire. Their house was set on fire. Rahul was crying. Rahul was crying out loud. He could see his house set on fire. You know what? At the backstage, Mrs. Rahul was very happy. She said, "Yay, house got fire, house got fire. I had already taken fire insurance on our house. I had already taken fire insurance on our house." This made Rahul happy. This made Rahul happy. Sir, if house is destructed, if house has been destroyed, or if any capital asset has been destroyed, it would be wrong to charge capital gain in the year of destruction. Therefore, provision says if any asset is destroyed, capital gain will not be charged in the year of destruction. It will be charged in the year in which insurance money has been received. How capital gain computation will take place? Provision says if I had acquired house on 1st April 2001, destruction took place. Destruction took place on 1st April 2020, and insurance compensation received was 1st April 2024. Provision simply states that whatever the insurance money that you receive shall become the full value of consideration. Sometimes what happens is insurance is not received. Sometimes insurance is not received. Instead, insurance company directly gives you new house. So in that case, provision says whatever the FMV of the new house shall become full value of consideration. Okay, sir, we got this point. Whatever the cost of acquisition for Rahul, that shall be the cost of acquisition of this house. So if required indexation to be done, then in that case, indexation shall be done from 1st April till the date of destruction. So this must be very clear. This must be borne in mind that indexation shall be done up to the date of destruction only, and the period of holding for the purpose of calculating long term, short term, this shall be taken up to the date of destruction only. Okay, sir, we got this point. Simple provision. Simple provision, destruction of capital asset. Destruction of capital asset. Yes, sir. We got this point. Destruction of capital asset. We got this point to the fullest. Okay, sir. FMV on which date, sir? FMV of asset on the date on which house has been given to us, or FMV of asset actually. See, if I have been, if my house was destroyed and in return I have got a house, if I have got a house worth rupees 1 crore, so whatever the worth is, whatever the worth of the house that on the date on which I received such house shall be taken. Whatever the worth of that house is on the date on which I received the asset shall be taken. Sir, conversion of capital asset into stock in trade. Sir, for example, my father had already acquired a big chunk of land, a big chunk of land. He already knew I am not going to do anything good in future. He already knew I am not going to do good any. I am not going to do any good in future. He said, "What teaching you are doing? What teaching you are doing? Instead of teaching, why don't you join our property business?" I said, "I will join, but what do I do in that business?" My father said he had already acquired a piece of land way back in 2001. He wanted me He wanted me to get that property constructed on that piece of land, and he requested me to sell such houses. Provision said earlier I had a piece of land which was held as capital asset. Earlier I had a piece of land which was held as capital asset acquired on 1st April 2020, 2001. Later on 1st April 2022, I decided to convert such capital asset into stock in trade. I decided to convert such capital asset into stock in trade. Provision says any conversion will amount to transfer. Yesterday only we studied this provision that conversion of capital asset into stock in trade amounts to transfer. Therefore, whenever I decide to convert such capital asset, that shall also amount to transfer. But what wrong is, sir? Actually, I have not realized anything. I have not realized anything, sir. Whatever capital gain that I have been charged is only on the paper. I have not realized any money now. So it would be wrong to charge tax in my hands. Therefore, provision says, sir, you will be taxed in the year in which actual stock in trade is sold. Taxation will take place in the year in which actual stock in trade is sold. And also, sir, this might be possible that we might not be able to sell complete property in 1 year. So provision says whatever the proportionate stock and trade is sold, that proportionate capital gain will become taxable. So, sir, for example, if property was acquired for 10 lakh rupees, conversion took place on 1st April 2022, and at the time of conversion, the fair market value of such property was 1 crore. And later on in 2024, I was able to sell only one third of the land, one third of the houses. Provision says capital gain computation will take place on this date only. In previous year 2023, capital gain computation will take place. So whatever the capital gain is, full value of consideration, for how full value of consideration shall be taken? Sir, full value of consideration shall be FMV on the date of conversion. Whatever the FMV of this property was, whatever the fair market value of the property was on the date of conversion shall be taken as full value of consideration, 1 crore. Minus cost of acquisition or index cost of acquisition. Sir, since asset has been transferred prior to 23rd July, then indexation would be allowed to us. In that case, indexation would turn out to be 10 lakh divided by. Indexation would turn out to be 10 lakh divided by 100 multiplied by previous year 22-23 CII. Previous year 2023 CII. What it was 22-23 CII 331. It shall turn out to be 33 lakh 10,000. Capital gain will turn out to be 66.9 lakh. 66.9 lakh will be the capital gain turning off. So this capital gain will not be taxed in previous year 22-23. This will not be taxed in 22-23. Rather, it will be taxed in the year in which actual stock in trade is sold. And whatever the proportion of capital gain that is being, whatever the proportion of stock in trade is being sold, that only will be taxable. So out of the 66.3, one third of this capital gain will be taxable in previous year 24-25. One third amount is 22.3. Sir, my question to you all is, you already know this provision. This is not something that I am teaching for very first time. You already know this provision. My question to you all is, sir, what will be the tax rate applicable? Uh, oh. Sir, what will be the tax rate applicable? Hmm. What will be the tax rate applicable? See, if conversion took place prior to 23rd July, conversion took place on, sir, 1st April 2022. Conversion took place on 1st April 2022. And actual taxes being charged in previous year 24-25 because one third of the property is sold at that time. Best in the world says tax rate on the rate of conversion. What other people say? What other people say? Date of conversion. What's your name actually, best in the world? What's your name? It would be great if I could write your name. What other people say? So what should be the rate? Sir, tax rate that shall apply shall be 20%. Tax rate at the rate 20% shall apply. Provision says if any transfer took place prior to 23rd July, if any transfer, Arjun, okay, perfect, Arjun. See, if any transfer took place prior to 23rd July, then whatever the transfer took place shall be taxable at the rate 20% only. And if transfer take place after 23rd July, then in that case, tax rate shall become 12.5% in this case. So for our case, it shall be 20% only. We have to check the date of transfer and then apply the tax rate. We have to check the date of transfer and then we have to apply the tax rates. I hope you got the point. Sir, in this portion, there is an important provision. In this portion we have an important provision. So if you all remember, we had a provision called 54 EC. Whenever we used to have capital gain on account of sale of any kind of immovable property, then we can avoid such capital gain. We can claim exemption on such capital gain via investing in the bonds of NHAI, in the bonds of RECL, in the bonds of PFCL, in the bonds of IRFCL. We used to have exemption. Then exemption was allowed up to rupees 50 lakh. If you also remember, such bonds were to be purchased within 6 months from the date of transfer. If you remember, such bonds were to be purchased within 6 months from the date of transfer. Provision says, Provision says if you are required to purchase bond, then you have to purchase bonds from 6 months from the date of transfer. But will it not be wrong? Will it not be wrong to have 6 months from the date of transfer? Because actually we are not realizing anything now. Actually, we are not realizing anything now. On the date of transfer, or I should say on the date of conversion, we are not realizing anything. So considering 6 months from now, from that time shall be wrong now. So provision says we will not take 6 months from the date of transfer. In this case, we will take 6 months from the date of realization of stock. From 6 months from the realization of the stock, we will be taking 6 months. Okay, sir, we got this point. Okay, sir, we simply got this point. It is not that difficult portion. It is actually a simpler portion, sir. Everything is simple. So third important special case is compulsory acquisition under any law. You remember, you know Sarthak sir, Sarthak Jain sir. You know Sarthak Jain sir. Actually, na, teaching is a sideline profession. Teaching is a sideline profession. He is not the actual teacher. You know, his actual profession is cultivation of opium. His actual profession is cultivation of opium. He has a very big agricultural land into the dense forest of Calcutta. In dense forest of Calcutta, he has a very fertile land where he grows opium and from which he earns nearly 4 to 5 crore rupees per annum. This teaching is just to convert black money into white money, but actual money is cultivation of opium. He grows opium and sells it all over the world. He earns 4 to 5 crore per annum via selling the opium into the dense forest of Calcutta. Once, once upon a time, a lady saw this piece of land. Lady saw this piece of land, and lady's name was Mamata Didi. She said, Ina cholbe, Ina cholbe, Ina cholbe, Kaka Chichi, Kaka Chichi. She started shouting out. She started shouting out and she said, Kaka Chichi, Ina cholbe, Ina cholbe. She said, we want your piece of land. We want your piece of land and we want to construct a temple, a Durga Mata temple at that mandir place, at that agricultural land. Mamta Didi said, we want your land and we want it for the temple construction. Oh my God. Oh my God. Sorry for Sarthak sir. Really sorry for Sarthak sir. What Mamta Didi gave in return, you know? She said, I will be giving you 40 lakh rupees. I will be giving you 40 lakh rupees. Chi, 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 chi. Just imagine a person earning 4 to 5 crore from a piece of land, and that piece of land has been acquired, and in return, he is just getting 40 lakh rupees. Isn't it something very wrong with him? Isn't it something very wrong happening with him? And answer is yes. Provision says if any of the immovable property or if any asset has been acquired under any law, if any compulsory acquisition takes place under any law, then whatever the first compensation that has been announced, that shall become initial compensation. That means this 40 lakh rupees which has been given to Sarthak sir shall become the initial compensation. But sir, Sarthak sir will not be satisfied with this initial compensation. He might go to court, he might go to collector to get this compensation increased. He might sue to Mamta Didi to increase the he might sue to Mamta Didi on High Court to get the increased compensation. Yes, sir, he might sue anybody just to get the compensation higher. So provision says whenever this initial compensation is being enhanced by either court or it has been enhanced by collector, then such enhanced compensation is taxable separately. So at first Mamta Didi said 40 lakh rupees will be 40 lakh. We will be giving compensation of just 40 lakh rupees. Later on, Sarthak sir went to court and Sarthak sir requested court for enhanced compensation and court awarded 4 crore rupees of enhanced compensation. Then in that case, this 40 lakh will be taxable separately. 4 crore of enhanced compensation will be taxable separately. How calculation will take place? Provision says, sir, out of this 40 lakh rupees of initial compensation, whenever Sarthak sir is going to receive first installment of such initial compensation, then entire initial compensation will be taxable. In that year, entire initial compensation will become taxable. For example, Sarthak sir received 10 lakh rupees in previous year 24-25. Sir, provision says full value of consideration in previous year 24-25 will become 40 lakh rupees. It will become 40 lakh rupees. Whatever the cost of acquisition is, sir, shall be reduced. Whatever the index cost of acquisition, in case if required, then index cost of acquisition shall be reduced. What period of holding? Period of holding shall be taken from the date of acquisition till the date of compulsory acquisition. This way, we will be taxing the initial compensation. There might be possibility that we may get this as loss. We may get a loss in this initial compensation. We may get a loss. As regard to enhanced compensation, provision says enhanced compensation shall be taxable only. Enhanced compensation shall be taxable only as and when received. Oh my God, as and when received. If enhanced compensation is awarded 2 years later, 5 years later, 10 years later, it is not relevant. It will be only taxable as and when received. And how it will be taxable? Provision says whatever the enhanced compensation amount is shall be taken as full value of concession. Sir, no cost of acquisition shall be allowed since all cost of acquisition has already been taken. So in this case, litigation expenditure is allowed. And sir, whatever the amount is, capital gain, long term, short term, shall be taken. A important point. A important point to note, sir, if initial compensation yielded long-term capital gain, then in that case, capital gain on enhanced compensation shall also be long-term. If initial capital gain yielded long-term capital gain, then in that case, enhanced compensation will be long-term by default. If initial compensation was short-term, then enhanced compensation will be short-term by default. By default. Also, if any of the enhanced compensation is being received on account of interim order of the court, then it shall not be taxable. Rather, it will be taxable in which final order, in the year in which final order is passed. So, sir, for example, court already knew that the government has to pay certain sum. So, court ordered 1 crore rupees to be paid as an interim order. Provision says if Sarthak sir receives any kind of interim compensation, or if he receives any enhanced compensation on account of interim order of the court, provision says it is not taxable in the year of receipt. It is taxable in the year in which final order is passed. I hope things are very clear. I hope things are very clear in this case. We have a question. Shubham, hi sir, I am CA final student, done DT, and by this weekend IDT will be finished. One group revision not done अच्छे से, so need time for group one sir. Should I give both groups, Shubham? Okay. May 25 gave only second group, scored 130. November 24 both groups say. Shubham, my personal opinion would be go for second group only. Don't go for both group. Don't go for both group. At least you should do 3 revisions before attempting any exam. If you are doing anything lesser than that, then it will not be worth it. It will not be worth it because paper standard is being increased every year. So for that matter, if you are just going to appear, if you are just willing to appear for examination, that it may not be worth it. So certain important points in this compulsory acquisition. Certain important point. What are these point? Provision says if any, if we have any asset that has been compulsorily acquired, government pays compensation on that. Government pays compensation on that. Sir, sometimes government delays the compensation. For that matter, we are also awarded interest on such compensation. For that matter, we are awarded interest on compensation. Provision says whatever the interest that we are getting shall be taxable under IFOS, and we will get a flat 50% deduction on such interest. Sir, simple provision, we got this point. Sir, for example, if court reduces the compensation, for example, I was awarded 40 lakh rupees, court intervened and court said 40 lakh is already more, you should be getting 20 lakh. In that case, AO will do rectification in this order to reduce the compensation and calculation of tax capital gain. AO will himself do the rectification. Sir, if I have any urban agriculture land and that has been compulsorily acquired by government and I had used that land for at least 2 years and sir RBI paid the compensation, then in that case, sir, such capital gain will be exempt. Sir, if I get any compensation under section 96 of Right to Fair Compensation, Transparency, Land Acquisition, Resettlement, Rehabilitation Act, then in that case, such compensation will be always exempt. Provision says a beautiful thing. A beautiful line has been said by provision. Just listen to this. Sir, for example, I had a property. I had a property. My property was compulsorily acquired. And I actually have no argument in I don't have actually argument. I just want my compensation to be raised. I have no argument to whatsoever that whether it should be acquired or not. I'm okay with the acquisition. But I just want my compensation to be increased. So instead of going to court for instead of going to court and suing the government, what I did was I just went to collector. I just went to district magistrate. I just went to district collector to get my compensation increased. My property was compulsorily acquired. It was exempt. No capital gain was going to arise. But sir, I just wanted more compensation, so I went to district collector for getting the compensation enhanced. Provision said, assessing officer said, I will treat it as voluntary sale. I will not treat it as compulsory acquisition. I will treat it as voluntary sale and tax such transaction. Oh my God. See, if my urban agriculture land is compulsorily acquired, it is exempt now. If my urban agriculture land is compulsorily acquired, RBI pays the compensation. I had used that land for 2 years. It is exempt now. So at the time of acquisition, I did not sue the government. I went to collector just to get my compensation increased. Assessing officer said, no, 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 it is not compulsory acquisition. We will consider it as voluntary sale. You are yourself giving such property to the government, so it is voluntary sale. What type of argument this assessing officer is making? This senseless argument. So it is completely senseless thing. If I am if I am just giving my property at the time of compulsory acquisition, that does not mean I am doing any kind of voluntary sale. It is compulsory acquisition only. Going to collector and asking for more compensation will not change the nature of this exemption to voluntary sale. Okay, sir. Okay. Sir, for example, there was person X. There was person X whose property was compulsorily acquired. He was fighting in court just to get the enhanced compensation, and at some point of time he died. Then who will whoever will be receiving the enhanced compensation, such enhanced compensation shall be taxable in his hand. For example, Mr. X died and enhanced compensation has been received by son of Mr. X, then it will be taxable in the hands of son of Mr. X only. That means whatever the legal hire who received the enhanced compensation, that shall be taxable in their hands only. Section 45. 5A, sir, talks about capital gain in case of joint development agreement. Capital gain in case of joint development agreement. Sir, what this provision says? This provision says if any individual and HF, sir, I want you all to highlight this point. I want you all to highlight this point. Why, sir? Because, sir, it is only applicable for individual and HUF. No other person can claim this joint development agreement benefit. It is only given to individual and HUF. Provision says if any individual, best in word says, sir, when capital gain is taxable in case court retains the amount which was received from the government due to litigation proceedings between the assessee and the government. See Arjun, what happens is whenever either order is passed or compensation is received. Normally, whenever court passes an order that this amount is to be paid, court normally pays that amount, and other person also who is required to pay pays the amount. So, for that matter, whenever court order is passed, that is the due date. If court has held some money with itself, that means order has not been passed yet, so it will not be taxable. If it has been held by the court, it will not be taxable. It will be only taxable when final order is passed. Capital gain in case of joint development agreement. What this point says. See, if I have a piece of land and I don't have money to get it constructed, I don't have any money to get house constructed on it. If I have a piece of land which is 5 acre, 5 acre of I should say 2 hectare, 2 hectare land. Now I don't have any money to get the house constructed. I don't have any money to get house constructed. So what I did, I gave this property to Mr. Lodha developer. I gave this property to Lodha developer, and in turn, he promised to get houses constructed. To get houses constructed, and in turn, he promised to give me 5 crore rupees and two flats worth rupees 1.2 crore. Oh my God! I have given my piece of land. In return, what I am getting 5 crore rupees and two flats worth rupees 1.2 crore as soon as the construction is complete. As soon as this construction is complete. Provision says whenever I am handing over my property to Mr. Lodha, whenever I am handing over my property to Mr. Lodha, in that case, In that case, transfer shall take place. Because if I am giving possession of my immovable property to any person, then in that case, transfer take place. Therefore, this should be taxable. This should be taxable as soon as I handed over the property to Mr. Loda. Provision says capital gain will not arise. Capital gain will arise only in the year in which completion certificate has been issued to Mr. Lodha. What I am saying is, ideally, whenever I am transferring the asset, capital gain should arise, but provision says capital gain will not arise in the hands of Mr. Rahul. It will arise in the hands of Mr. Rahul when completion certificate is being received to Mr. Lodha. Sir, how capital gain will be computed? Provision says whatever the stamp duty value of the property plus the money that he is receiving shall become the full value of concession. For example, in our case, Rahul was given 1.2 crore rupees flats, two flats. That means 2.4 crore is the property that is being given. 5 crore is the cash that he has been given. So, total consideration will be 7.4 crore for this piece of land. Whatever the cost of acquisition was, so that shall be indexed till the date of handing over the possession. Period of holding shall be taken from the acquisition till the date of completing the possession. Sir, very important thing, very important section. But what matters is, sir, indexation shall be done. Sorry, what matters is, sir, capital gain shall be charged to tax in the year in which completion certificate is issued. Completion certificate is issued, that shall be year in which capital gain shall be charged to tax. Cost of acquisition of the share received in joint development agreement. Sir, for example, later on, Rahul decided to sell such flats. Then, sir, what will be the cost of acquisition for Rahul? It is assumed now whatever the SDV of the property is, that shall become cost of acquisition for Mr. Rahul. Sir, there is no extra necessity to guess such thing. Whatever the SDV of the property is shall become cost of acquisition for Mr. Rahul. Whenever I will be selling such flats, the cost of acquisition taken shall be with the SDV that I had received. Sir, another important portion, sir, we need to understand this. See, for example, if I had a property worth rupees 10 lakh rupees, and I give that property to Mr. Lodha, and in turn he promised me to give 5 crore plus two flats worth rupees 1 crore. Just for the sake of simplification, I am taking 1 crore. That means he is giving me 7 crore worth rupees compensation. Got it? Sir, year of acquisition was 1st April 2002. Year in which I handed over possession was 1st April 2021. And year of completion. Praveen says, why you cancelled the May 26 batch? Time waste ho gaya, sir, 1 month ka. I feel really sorry for that, Praveen. I mean, there were some personal issues. There were multiple issues with that batch, so I could not continue it. I really feel sorry. We'll continue it in September. I'm really sorry for that. I'll talk to you in person. Okay? I mean, really feel sorry for your loss. Really feel sorry. Because of some urgent commitments, I had some personal reasons that I had to be somewhere. I could not take that batch. It is not something I wanted to do intentionally, but in front of everybody, I am saying sorry. Sir, what provision is all about? What provision is all about? I had a piece of land. I handed over to Mr. Lodha. Arjun, SDV is FMV only. If you are asked about the FMV of the property, you will get SDV only now. As See, one of the way of calculating FMV is SDV only. So if SDV is most reasonable. If any property is being newly constructed, if a property is being newly constructed, I'll call you Praveen today. I'll call you. If a property is being newly constructed, then in that case, how can you calculate the FMV? SDV is on the only FMV. Listen to the point that I'm saying. Just listen to the point. It is very important point for your examination also. Just understand. Sir, for example, if I had a property acquired for rupees 10 lakh and I gave that property on 1st April 2021. I gave that property on 1st April 2021 to Mr. Lodha, and completion certificate was issued on 1st April 2024. Completion certificate was issued. Completion certificate was issued on 1st April 2024. Now what happens if Rahul requires certain money and he sells such flat before completion certificate? See, completion certificate was due to be issued on 1st April 2024. But if Rahul sells such property, if Rahul if Rahul sells such property before 1st April 2024, then provision says this section will not be available to Rahul. Why? Because this benefit was given only to Rahul because he had cash crunch. He did not have money to pay taxes. Therefore, this benefit was given to him. Provision says. Provision says if he gets the money, then in that case, he has to pay taxes before completion certificate only. Are you getting my point? Are you getting my point? This benefit was only given to him because he did not have sufficient money to pay the taxes. But since he sold the asset, this section will not be allowed. He will be taxed in the year in which such property is sold. Such asset is being sold by Mr. Rahul, he will be taxed in that year only. Government will not wait for completion certificate to be issued. He will be taxed in the year in which he sold the flats before issue of completion certificate. Important section from examination point of view. Examiner may confuse you with these provisions. All these four were the exceptions. All four were the exceptions to section 45(1). What we had started is, sir, computation of capital gain in special cases. Four special cases were exceptions, where transfer took place in some other year and capital gain is taxable in some other year. Now we are going to start with very special cases. And you might see some questions from these other special cases only. You might see some questions from these special cases only. So, first of all, starting with is ULIP taxation. See, Acha, everything is clear till now? Are you all clear with everything that we had studied till now? Any doubt till now? Are you? Yes, sir. Absolutely clear. Okay. Starting with taxation of ULIP. Sir, what actually ULIP is? So ULIP are actually nothing but life insurance policies with a blend of mutual fund. Life insurance policy with a blend of mutual fund. Sir, what is the classic benefit of life insurance policy? So life insurance policy is normally exempt. Maturity at the time of life in case of life insurance policy is exempt. So they tried to cover it up. They tried to name it as life insurance policy, but they invest a certain sum in mutual fund also. So ULIP is nothing a blend of life insurance policy and sir mutual funds. Provision says any life insurance policy who satisfies the condition of 1010D shall become exempt. Any life insurance policy which satisfies the conditions of 1010D shall become exempt. Sir, what 1010D says? 1010D says if any policy is issued prior to 1st April 2012, then annual premium shall be less than or equal to 20% of sum assured. Annual premium shall be less than or equal to 20% of sum assured. Sir, for example, annual premium is 10 lakh. Sorry, sum assured is 10 lakh. Then annual premium shall be lesser than or equal to 2 lakh. If policy is issued on or after 1st April 2012, then in that case, annual premium should be less than or equal to, sir, 10% of sum assured. This 20% limit was reduced to 10% on or after 1st April 2012. 1st April 2012. Okay, sir, we got this point. We got this point. Sir, if any kind of life insurance policy, whose annual premium is less than 10% of the sum assured or equal to 10% of the sum assured, then in that case, majority of such life insurance policy is exempt. Majority of life insurance policy was exempt. People tried to make certain instruments in which it appeared that money is being invested in life insurance policy, but most of the sum was going to mutual fund. Most of the sum was going to mutual fund. It appeared that it was life insurance policy, but actual such transaction was in the mutual fund. Therefore, government had to tax such insurance policies. So these insurance policies were nothing but ULIPs, unit linked life insurance policies, which appeared to be life insurance policy, but ultimately they were the mutual funds that people were buying. So government came up with a rule. What rule came out to be? So this is the table. I want all of you to have a screenshot of this. I want all of you to have a screenshot of this. Sir, taxability of ULIP. Taxability of ULIP and life insurance policy, what it says. First of all, sir, if any of the policy whose sum assured exceeds 10%, sum assured exceeds 20%, sum assured exceeds 15%, then in that case it shall always be taxable under that IFRS. Maturity will always be taxable under that IFRS. Sir, it must be borne in mind that if annual premium exceeds 10% the limit, 10% of sum assured, if annual premium exceeds 20% prior to 1st April 2012, or if annual premium exceeds 15% in case of specially abled people, then in that case it shall always be taxable under the IFRS. This must be very clear. So this is not ULIP, this is always taxable. Okay, sir, we got this point. But sir, if annual premium is within limit, then we have to check whether we are buying ULIP or we are buying LIP, life insurance policy, or unit linked insurance policy. Sir, if any ULIP is bought or issued on or before, if ULIP is issued before 1st Feb 2021, if any ULIP is issued prior to 1st Feb 2021, whatever sum you are paying, whatever premium you are paying, if that premium satisfies the 10%, 15%, 20% criteria, it shall be exempt. Whatever money you are paying, whatever premium you are paying, sir, premium can exceed to 1 crore, premium can exceed to 10 crore, premium can exceed to 100 crore. But sir, if such premium is less than 10%, 15%, 100, 20% of the sum assured, then in that case, majority was exempt. Majority was completely exempt, completely exempt. But sir, change came on 1st Feb 2021. Change came on 1st Feb 2021, where Nimotai said, if aggregate premium is up to 2.5 lakh rupees in one or multiple ULIPs, then it shall be exempt on maturity. But sir, if aggregate premium on any of the ULIP or aggregation on multiple ULIPs exceeds 2.5 lakh, then sir, it shall be taxable under the head capital gain. So important point is, sir, if any ULIP is being issued prior to 1st Feb 2021, then any premium paid shall be exempt at the time of maturity. Any ULIP bought shall be exempt at the time of maturity. But sir, if any of the ULIP is issued on or after 1st Feb 2021, then in that case, ULIPs aggregating to 2.5 lakh rupees shall be exempt. Any ULIP exceeding 2.5 lakh limit shall become taxable, and taxability will come under the head capital gain. That is why, sir, at the time of charging section, we studied, so ULIP on which section 1020 does not apply shall be taxable under the head capital gain. Did you get this point or not? Sir, we'll study things in detail. Sir, let us understand this with an example. Sir, for example, I had a ULIP fund. Which I had acquired on 1st Jan 2021. I had a ULIP which I had acquired on 1st Jan 2021. Sir, is it prior to 1st Feb? Yes, sir, it is prior. Any premium paid, if it satisfies the 10%, 15%, 20% criteria, that shall be exempt. Let us for now assume it is just a 10% criteria. 20% is prior to 1st April 2012, so we don't need to remember that. Sir, you will satisfy 10% criteria. I think, sir, sum assured is 50 lakh rupees, annual premium is 5 lakh rupees. That means it is within 10% limit. So any premium paid, sir, is allowed. Maturity is exempt. Sir, maturity on this ULIP will be exempt. Whatever maturity that I am receiving on this ULIP is exempt. Okay, sir, we got this point. Sir, if premium is up to 10% of sum assured, then any maturity received will be exempt. Any maturity received will be exempt. Sir, we got this point. ULIP 2. ULIP 2, what this says, sir, if any, sorry, ULIP 2 was issued on 1st Feb 2021. Can I say with effect from 1st Feb, individual or aggregate ULIP should be up to 2.5 lakh, otherwise it will become taxable? Yes, sir. Sir, does it follow the 10% criteria? Right answer is yes, sir. It follows the 10% criteria because, sir, sum assured is 12 lakh and annual premium is 1.25 lakh, 1.2 lakh. That means it satisfies the 10% criteria. Sir, if it satisfies 10% criteria, but if annual premium exceeds 2.5 lakh, then it should be taxable. But annual premium is up to 2.5 lakh. So this should be exempt. This should be exempt. Achha, any premium paid before that shall not be considered into 2.5 lakh limit. Any premium paid prior to 1st Feb 2021 shall not be considered while considering the limit of this 2.5 lakh. Okay. Again on 1st March 2021. Again on 1st March 2021. I bought another ULIP worth rupees 13 lakh. I bought another ULIP on which sum assured was 13 lakh rupees and annual premium was 1.3 lakh. Annual premium was 1.3 lakh. Sum assured was 13 lakh, annual premium was 1.3 lakh. Sum assured was 13 lakh, annual premium was 1.3 lakh. Again, do I fulfill the criteria of 10%? Right answer is yes, sir. Criteria of 10% is being fulfilled. Sum assured is less than 10%. Sum assured is annual premium is less than equal to 10%. Yes, sir, we got this point. Annual premium is less than equal to 10% of the sum assured, sir. Okay. Annual premium is less than 2.5 lakh also. Annual premium is less than 2.5 lakh also. Yes, sir. Right answer is therefore this should also be exempt. Okay, sir. This should also be exempt. ULIP 4. Sir, on 1st April 2021, new financial year started. Somehow I got some more money. I got more money. From which I bought another ULIP on which sum assured was 24 lakh and annual premium was 2.4 lakh. Sir, does it satisfy 10% criteria? Right answer is yes, this satisfies 10% criteria. Sir, is it below 2.5 lakh? Right answer is yes, sir. It is less than 2.5 lakh. Should this be exempt? Sir, I need to check the annual premium. Just imagine I am paying premium of rupees 2.4 lakh on 1st April 2021. When Feb 2022 will come, 1st Feb 2022 will come, I have to pay premium of 1.2 lakh on this ULIP 2. On 1st March 2022, I will be required to pay 1.3 lakh rupees of premium on this ULIP 3. That means aggregate premium during this financial year. Aggregate premium for financial year 21-22 exceeds 2.5 lakh. ULIP 1, ULIP 2, ULIP 2, ULIP 3, ULIP 4, all three combined exceeds the limit of 2.5 lakh. Then we have a choice. We can either take ULIP 2 and 3 as exempt, majority of ULIP 2 and ULIP 3 as exempt, or we can claim ULIP 4 as exempt and we can tax the ULIP 2 and ULIP 3. Whatever the policies that you have bought on which the aggregate premium is up to 2.5 lakh, you can claim exemption. On ULIP 2 and ULIP 3, aggregate premium is up to 2.5 lakh, you can claim exemption on that. On ULIP 4, aggregate premium is up to 2.5 lakh, you can claim exemption. But sir, you can claim exemption only on those ULIPs on which aggregate premium is not exceeding 22.5 lakh. So here I have a choice. So ULIP 2 plus ULIP 3, I can claim exemption and get ULIP 4 as taxed. Or I can do vice versa. ULIP 4 I can claim as exemption and ULIP 2 and 3 pay taxes on that, taxes on maturity. Anything I want to do, whatever beneficial is for me, I can do that. I can do that. Simple point it is. ULIP 5. I am buying another ULIP on 1st May 2021. Provision says, so sum assured is 3.35 lakh. Annual premium is 3.5 lakh. See, if annual premium is 3.5 lakh, whether or not, if I fulfill 10% criteria or not, sir, that is not relevant. I will be charged to capital gain. I will be charged to capital gain in this relevant provisions. I will be charged to capital gain in this relevant provisions. Sir, whatever the amount is shall be taxable under that capital gain. This will be taxable. Sir, ULIP 5 will definitely be taxable at the time of maturity. Just tell me, did I make ULIP clear? Was it clear to you all? Was it clear to you all? How capital gain will be computed in case of ULIP? Sir, whatever the taxables, whatever the sum that you receive at the time of maturity shall be taken as amount received. Whatever the premium you have paid till now shall be reduced, and sir, no indexation will be allowed whatsoever. Also, sir, long-term capital gain under section 112A will come in case of ULIP taxation, because sir, ultimately your money is being invested in mutual funds, equity-oriented mutual funds only they invest. Therefore, it will be 112A. Did I make ULIP very clear? Any doubt in ULIP? If yes, then you can ask. Otherwise, we can proceed with life insurance policy. Taxation of life insurance policy. See, taxation of life insurance policy is covered in IFOS, but it is more relevant for all of us to study here only because sir, it is somehow related to ULIP only. See, what happened was normal life insurance policy, which satisfied the condition of this 10%, 15%, 20% criteria, was exempt. Normally, majority of this life insurance policy was exempt if it satisfied the 10%, 15%, 20% criteria. But what people used to do was they used to buy life insurance policy of 10 crore in a year. 10 crore in the year, and they used to get majority amount of 100 and 100 of crore, which was exempt. So provision says we need to tax it. Provision says we need to tax it. What it said, if you are buying any life insurance policy which is being issued prior to 1st April 2021 and it satisfies 10% criteria, then majority will be exempt. So majority will always be exempt. Majority will always be exempt. But if life insurance policy is issued on or after 1st April 2023, if life insurance policy is issued on or after 1st April 2023, then you have to check whether aggregate premium on all the life insurance policy is up to 5 lakh rupees or not. If it is up to 5 lakh, then majority will be exempt. But if aggregate premium is beyond 5 lakh rupees, then in whatever policies aggregate premium exceeds 5 lakh, or because of whatever policies premium exceeds 5 lakh, such policies will become taxable at the time of maturity. And in case of life insurance policy, taxability is calculated under income from other sources. Simple provision it is. Sir, if premium is up to 5 lakh on all policies will become exempt. If premium exceeds 5 lakh, then whatever policies on which premium exceeds 5 lakh, that shall become taxable. Simple. Sir, let us understand this with an example. If I buy a policy, sum assured is say 80 lakh. Annual premium is say annual premium, what do I do? Annual premium, sir, 4.8 lakh. My question to you all is, if I add GST to this annual premium, GST 18%, See, I'm not aware about the actual GST rate on life insurance policy, but if I add GST to this, sir, my life insurance premium will become 566,400. If I consider such premium before GST, then it is within 5 lakh limit. But if I consider this premium after GST, then this exceeds the limit. Sir, what do I do in this case? Will the maturity be taxable or maturity be exempt? Will the maturity become taxable or maturity will be exempt? Sir, what do I do? What do I do? What do I do? Sir, whenever you take premium, whenever you take premium, sir, it is always taken before GST. That is, as Arjun said, sir, after GST amount is not considered. For the purpose of calculating the 5 lakh limit, GST is excluded. GST is excluded. Did I make it very clear? Yes, sir, it is absolutely clear. Sir, GST is not included in the aggregate premium for the purpose of calculating 5 lakh limit. Yes, sir, we got this point. Perfect, Arjun. Perfect, perfect, Arjun. Beautiful. Sir, another provision. Sir, for example, if I buy a life insurance policy, for example, 6 lakh rupees per annum premium. Maturities, I paid premium for 10 years and maturity amount is say 80 lakh. Maturity amount is 80 lakh. I want to know, I want to know what will be the taxable amount. What will be the taxable amount at the time of maturity? What will be the taxable amount at the time of maturity? See, life insurance policy, premium is 6 lakh. See, even though it is within 10% limit, even though it is within 10% limit, but since aggregate premium exceeds 5 lakh, it should be taxable. Aggregate premium exceeds 5 lakh, it should be taxable. Yes, sir, it should be taxable. Sir, money that I am receiving on maturity is 80 lakh rupees. So for that matter, there should be some amount which is taxable. Sir, what should be that amount? I want you all to answer. I want you all to answer because, sir, this is not the provision that I'm doing for myself. I'm doing for all of you. So I want answers from you all only. If you are watching this lecture, the recorded one, then you can try solving it of your own. Comment down your answer and then I will see. I read comments. I do read the comments and reply to that. Sir, maturity amount is 80 lakh. Cost of acquisition will be 6 lakhs per annum for 10 years will be 60 lakh. IFO should be 20 lakh. So this is only how we have to do. This is only how we have to do. Right answer is not necessary. Right answer is not necessary. Sir, why not necessary? Just think, provision says, pata, what provision says? If in any of the previous year, if any of the previous year, you have taken deduction under say under chapter 6A, or I should say 80C, for this premium, since you are paying premium, you might have taken deduction under 80C. You might have deduction under 80C. Right answer is yes. We might have taken deduction. Provision says whatever deduction that you have taken on this life insurance policy, that shall stand reduced from cost of acquisition. So, for example, every year I used to take 1.5 lakh as deduction. So such 1.5 lakh shall be reduced and my cost of acquisition will turn out to be 45 lakh. My capital gain will turn out to be, sorry, my IFO's income will turn out to be 15 lakh. Even though it is just a presumption in our case, but in exam you will be given this note, you will be given something in the note that whatever the amount that we are paying for insurance premium, we are claiming it as deduction up to certain extent. So that amount which has been claimed as deduction under 80C shall be reduced from cost of acquisition. That shall be reduced from cost of acquisition. So what I told you till now, if any kind of LIP or ULIP exceeds the 10%, 15%, 20% criteria, that shall always be taxable under IFRS. That shall always be taxable under IFRS. If it fulfills 10%, 15%, 20% criteria, then we have to check whether it is ULIP or LIP. If it is ULIP and it is issued prior to 1st Feb 2021, that shall be exempt. But if it is issued on or after 1st April 2021, then in 1st Feb 2021, then in that case, whatever the ULIPs that have been bought, if aggregate premium on such pool ULIPs is up to 2.5 lakh, then it is exempt. Beyond that, everything will be taxable. Also, sir, about LIP, if any of the life insurance policies issued prior to 1st April 2023, sir, it is always exempt. But if it is issued on or after 1st April 2023, then whatever the premium you are paying, aggregate premium, if it is up to 5 lakh rupees, then it shall be exempt. Otherwise, it shall be taxable. Whenever you are considering the premium limit, then 5 lakh is to be considered without GST. 5 lakh is to be considered without GST, sir. It should not be taken with GST. Also, sir, ULIP is taxable under that capital gain. LIP is taxable under IFOs. Another important point, sir, if we receive any sum on account of key man insurance policy, if we receive any sum on account of key man insurance policy, that is taxable under that PGBP. We will discuss this under PGBP head only. When we will study PGBP, we will discuss about this point at that time. Also, sir, any kind of life insurance policy, any ULIP, any ULIP, any LIP, sir, whether it fulfills 10% wala criteria or not, whether it does not fulfill 10%, whether it is exceeding 2.5 lakh, whether it is less than 2.5 lakh, whether it is 5 lakh exceeding or not, whether it is less than 5 lakh. Sir, in every case, if it is received on the death, if it is received at the time of death of the assessee, it is always exempt. Whenever any LIP, whether any LIPs or ULIP is received on or at the time of death of any person, then it shall be exempt. So no taxability will arise under any head. No taxability will arise under any head. Sir, another special case, that is slum sale. Sir, what is this slum sale all about? What is this slum sale all about? Sir, sometimes we have multiple divisions in our units, multiple divisions in our unit. For example, I may have a textile business and chemical business. I don't want to continue textile business. I want to sell it off. If I have hardware and software unit, I don't want to continue the hardware unit. I'm just selling it off. Sir, most oftenly we sell off the entire unit altogether without assigning value to single assets. See, for example, if I have a software unit and hardware unit, for a hardware unit, I might have different debtors, I might have different investments, I might have different cash balances, I might have different other assets. I'm not allocating any value to individual assets. I'm not allocating any value to individual assets. Rather, for a whole lot of assets, I'm just charging a single consideration that is called slum sale. That is simply called slum sale. Sir, in case of slum sale, how capital gain is computed? Sir, very simple. It is full value of consideration minus cost of acquisition will give us capital gain. Full value of consideration minus cost of acquisition will give us slum sale, will give us capital gain. Sir, it is very simple provision. It is very simple provision. Full value of consideration minus cost of acquisition will give us capital gain. Okay, sir. Okay, sir. Sir, full value of consideration is calculated by considering FMV1 or FMV2, whichever is higher. And cost of acquisition is calculated by calculating net worth of enterprise. FEOC is considered via higher of FMV1 and FMV2. Cost of acquisition is calculated via considering the net worth of the enterprise. Okay, sir, we got this point. Now, what matters is how to compute FMV1, how to compute FMV2, and sir, how to compute net worth of the undertaking. As soon as we are done with these topics, we are done with slum sale. Okay, sir. Sir, important point. For a unit to become long-term capital gain, for a unit to yield long-term capital gain, that unit must be held for at least 3 years. See, earlier, Whatever assets were held for 3 years, now such period of holding is being reduced to 2 years only. Now we do not have, normally we do not have any concept of 3 years of period of holding after 23rd July. We have studied this in period of holding concept, that we do not have any concept of 3 years of period of holding right now. Every asset should be held for 2 years. It shall yield long-term capital gain. If it is held for 2 years or more, then it shall yield long-term capital, so long-term capital gain. But slum sale is the only exception to this list. Slum sale is only exception to this list. So slum sale is being governed by the provisions of section 50B, and section 50B even today clearly states that unit which is being sold shall be held for at least 3 years to make it long term. If it is held for 3 years or less than 3 years, then in that case it shall become short term. Oh my god. If a unit is being held for less than 3 years, or 3 years, sir, it shall become short term. Otherwise, sir, if it is held for more than 3 years, then it shall become long term. So, important point, examiner may ask, examiner may confuse you at this point. Sir, how valuation is being done in case of slum sale? How valuation is being done? Sir, I just want three things. I want FMV1, I want FMV2, and I want net worth. How net worth is being calculated? How net worth is being calculated, sir? Net worth is nothing but cost of acquisition. How cost of acquisition is calculated? See, whatever assets you have, whatever depreciable assets you have, take the WDV as per Income Tax Act, take written down value as per Income Tax Act. Sir, if any asset has been revalued, if any asset has been recognized at fair market value, just ignore such revaluation, ignore such fair market value estimation. Just take the book value, so WDV as per Income Tax Act. If any depreciation has been charged as per Companies Act, just ignore that. Just take WDV as per Income Tax Act. If you have any asset on which 35 AD deduction has been claimed, if you have any asset on which is self-generated, for example, brand name, take it as nil. And any other assets like data, like any other investments, like cash and cash equivalent, like any investment inventory, shall be taken at book value. As soon as you total them, you will get the total assets. You have to reduce liability. Don't reduce capital, share capital, or reserve surplus, because these are not liabilities. So whatever you reduce will give us net worth. Whatever you reduce will give us net worth. See, book value of normally all the assets, but for depreciable assets, you have to take the WDV as per Income Tax Act. In case of any asset, if any revaluation is being done, if any fair value recognition is being done, you have to ignore such. Also, sir, you have to reduce liabilities at the book value. You will get some net worth. Sir, if net worth turns out to be negative, then you have to ignore such net worth. Sir, we got this point. Are we clear how net worth is being calculated? Right answer is yes, sir. We got this point how net worth is calculated. We got this point how net worth is calculated. Sir, important aspect is how to compute fair market value. Important aspect is how to compute fair market value. Sir, whatever undertaking that I am transferring, sir, it might have had certain assets. It must be having certain assets now. It must be having certain assets now, sir. With undertaking, I am giving you away my debtors. I am giving you away my stock. I am giving you away my investments. I am giving you away my cash and cash balances. Everything I am giving away. Everything I am giving away. FMV1 says whatever the assets are given, take FMV of that. Take fair market value of that. Oh, this is the FMV1. And FMV2 states whatever things that you are getting in return. So, for example, if I'm giving my all assets, if I'm giving all of my assets and receiving 5 lakh rupees, then it shall be FMV2. If I'm not receiving any money, if I'm receiving any building, then buildings SDB shall be taken as FMV2. If I'm receiving jewelry against my bill undertaking, then that jewelry shall be taken as FMV, that shall be FMV2. If I'm receiving some shares, then that undertaking should be taken as FMV2. Yani sir, what it says, whatever assets you are transferring, FMV of such assets shall be FMV1. Whatever assets that you are receiving, FMV of such assets shall become FMV2. That is how you have to compute. So, for example, if you are transferring any undertaking, and such undertaking had certain assets like jewelry or artistic work, then take fair market value as per valuation report of a chartered accountant or merchant banker. If such undertaking had certain shares of Reliance or another shares, then in that case, sir, take fair market value of them. Sir, fair market value for listed shares can be fair market value for listed shares can be sir high average state quoted price. Fair market value for unlisted shares can be sir A plus B minus L, that we'll study later on. Sir, if such unit which has been transferred had certain immovable property, provision says take SDV, sir, take stamp duty value of such immovable property. No cost, no fair market value, only stamp duty value shall be taken. And any other assets other than this shall be taken at book value file while estimating the fair market value one. So three assets, sir, any kind of jewelry, gold, or any kind of painting, sir, take at open market value. If you have any shares, take it fair market value. If you have any property, take SDV, and any other asset shall be taken at book value. Any other asset shall be taken at book value. If you have any liabilities, liability shall be reduced. But remember, sir, share capital, reserves and surplus, dividend, provision for tax, uncertain liability, contingent liability are not liability. Sir, any kind of deferred tax, advanced tax, deferred revenue expenditure shall be completely ignored. It shall be completely ignored. Okay, sir. This will yield us FMV1. Sir, whatever assets that are given, the fair market value of those assets shall give us FMV1. In return, in consideration, if we are getting any money, that shall be taken as FMV2. If we are receiving any such shares, then that shall also be taken FMV of such shares. If we are receiving any jewelry vagera, then in that case, jewelry also shall be taken. Open market value of that jewelry should be taken. Or if in return we are getting some immovable property, then SDV of such immovable property shall be taken. Whatever things that we are getting in return, those assets FMV should be taken for the purpose of determining FMV2. Once we decide FMV1 and FMV2, the higher of two shall be taken as full value concession reduced by sir cost of acquisition. This will give us capital gain. Sir, whether it is long term or short term, it depends upon whether we held that unit for 3 years or more. Otherwise, it will become short term. Sir, valuation date implies a date on which slum sale took place. Valuation date implies date of slum sale. Also, sir, SSC is required to get a chartered accountant's report. Chartered accountant's report before, yeah, up to the date of tax audit, whereby it is being certified that net worth has been arrived correctly. Computation of net worth has to be certified by chartered accountant up to the due date of tax audit. Sir, if I want to avoid slum sale taxation, if I want to avoid taxation in slum sale, what options do I have? What options do I have? I have two options if I want to avoid taxation in slum sale. Sir, for example, if Rahul has two units, one is textile unit, another one is chemical unit. I want to hive off this chemical unit. I want to hive off or sell off this chemical unit. Provision says I have two options. Either I can do a demerger. As soon as I do demerger of this unit, sir, this shall become exempt transfer. Demerger amounts to exempt transfer. Or sir, another option I have. Sir, for example, I want to sell this chemical unit to for example, Arjun Limited. Arjun Limited. I want to sell off this chemical unit to Arjun Limited. I want to sell this unit from my business to Arjun Limited. How can I avoid taxes? Sir, I have an option to buy 100% shares of Arjun. To buy 100% shares of Arjun and make it my 100% subsidiary, then in that case, any transfer of capital asset shall become exempt transfer. So I have two options to avoid capital gain, so Islam sale taxation. So first of all is, sir, demerge the entity. Demerger amounts to exempt transfer. Second thing what we can do is, sir, we can acquire 100% of the shares of the company to whom we are selling, so that any gain or any transfer shall become exempt transfer. Sir, both of them are completely senseless. Both of them are completely senseless. But that is how things go. That is how things go. In one or two questions, you have been asked to provide certain tax saving tools from which we can avoid slum sale taxation. You have to answer these two. We can either demerge the entity, or we can acquire the 100% shares of the entity who is buying such entity. Who is buying such entity? Where we are right now? Where do we stand right now? Oof, 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 oof. Instruction done, conversion done, compulsory acquisition done, joint development agreement done, ULIP done, slum sale done. Let's do these three sections. See what this provision is all about. Acha, any doubt till now? Any doubt till now? Anybody having any doubt till now? No, sir, no doubt. Continuing further. Section 50 double A. This is a very beautiful section. What this section says, we will specify certain assets. Government says, we will specify certain assets. We will specify certain assets. Whenever you are going to have capital gain on certain assets, it will always be short term. Irrespective of the period of holding, irrespective of the period of holding, sir, capital gain on these securities will always be short term. Always, 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 always short term. So because government does not want to give any benefit of lower tax rates on these securities, any capital gain arising of these capital assets shall always be short term. Sir, what are those three securities listed in this section 50 AA? First of all is market linked debentures. Sir, what is market linked debentures? For example, I am in a need of money. I am in a need of money. I want money. Okay, I want money. I want to arrange it from somebody. I asked Arjun, can you lend me some money? I asked Arjun, will you lend me some money? Arjun said, of course, sir, of course. I do have a lot of money. I can lend you out. But what will I get in return? Arjun is asking me, what will I get in return? I said, I'll pay you interest. Arjun says, no, sir, no. Interest is not sufficient. How much interest you are paying? That should be answered. I said, Arjun, this is our home talk only now. This is this is the matter of our personal relation now. Whatever interest you charge, Arjun says, no, sir. I want this business connection to be very clear. This is our business loan. This is the business loan that I am giving you. We must be very clear with the interest. I promised Arjun. I promised Arjun that whatever the return Nifty 50 will give in next 1 year, I will pay 1.2 times the interest. If Nifty grows by 10%, I will pay 12% interest. If Nifty grows by 20%, I will give you 24%. If Nifty grows by 100%, I will pay you 120%. Whatever the growth of Nifty 50 is, I will pay you 1.2 times more than that. Sir, whether interest is fixed, right answer is no. Sir, in this case, interest is dependent upon any underlying asset, any underlying assets. That asset can be any share, that asset can be any market, that asset can be any index. Such kind of debentures are called market linked debentures, where interest on such debentures is not fixed interest. Interest is dependent upon any asset, any security, or any kind of indices. Such debentures are called market linked debentures. Interest on such debentures shall not be considered fixed. It shall be based on certain assets. If you transfer any such market linked debentures, that will always yield short term capital gain only as per section 50 AA. Second thing that is covered is Rita Verma. Sir, you teach really very good. Thank you so much, Rita. We do have a lot and lot of chapters, and you will get the real taste of my explanations in later chapters also. when we'll study MAT, when we'll study assessment, when we'll study NR taxation, when we'll study transfer pricing, when we study trust taxation, you will understand the real depth, real beauty of DT in these chapters. Okay, now specified mutual fund. Sir, what are specified mutual fund? First of all, any mutual fund that is issued on or after 1st April 2023. We must remember on or after 1st April 2023. If any mutual fund whose out of total receipts only 35% are invested in equity shares, only 35% are invested in equity shares. Out of the total proceeds, only 35% of the mutual fund invest in equity shares. So that is debt-oriented mutual fund. That is debt-oriented mutual fund. So only 35% you are investing in equity shares. Only 35% you are investing in equity shares. Provision says it is specified mutual fund. If out of 100%, only 35% are being invested in the equity shares of the domestic company and sir, it is issued on or after 1st April 2023, then such mutual fund is specified mutual fund. Any gain on such mutual fund will yield always short-term capital gain. Unlisted bonds and debentures. Unlisted bonds and debentures. What this says, what it says. Sir, if any unlisted bond or if any unlisted bond or debentures are being redeemed, transferred, or matured. If any unlisted bond debentures are either being redeemed, transferred, or matured on or after 23rd July 2024, then any capital gain will always be short-term capital gain. Any unlisted bond, debenture are being redeemed, are being matured, are being transferred will yield always short-term capital gain. This is a big amendment. Yesterday, I had asked a question on this point on my Telegram channel, and most of the people gave the wrong answer. Most of the people gave wrong answer. I would request you to answer it once. Yesterday, I had asked a poll about this question. You can answer this on Telegram channel, and let's see how much you understood this point. So this was all about section 50AA. So any kind of market linked debentures, any kind of specified mutual fund or any kind of unlisted bonds or debentures, so sold on or after 23rd July 2024, sir, will always yield short-term capital gain, sir. It will never yield long-term capital gain. Even though, sir, in indexation and all these three assets was not even allowed, it will not be allowed even today. Transfer in case of DMAT securities, what is this all about? Transfer in case of DMAT securities, sir, what is this all about? Just listen to this point carefully. Just listen to this point carefully what this says, what it says. For example, if I bought Reliance on 1st April 2024 worth rupees 1500. If I bought Reliance again on 1st May 2024 for 1600. I had old physical share. I had old physical share. Sir, bought in year 2012 worth rupees 300. And I got that share dematerialized on 1st June 2024. And again, I bought Reliance on 1st July 2024 worth rupees 1700. Now, if I am selling one share of Reliance, I am selling one share of Reliance. I am selling one share of Reliance. Provision says, what will be the cost of acquisition of the share? Will it be 1700? Will it be 300? Will it be 1500? Or will it be the average of all four? Will it be the last share that I have bought? Will it be the original share that was originally bought at first and now has been dematerialized? Or will it be 1500 that is first share of DMAT account? Or will it be 1275 that is weighted average price of all the shares? Right answer is first of all, sir, it will not be last share. It will not be last share. It will also never be the weighted average price. It will never be the weighted average price. So it will always be the first share that has been entered into account. You have to apply first in first out method, and that to first in first out method should be applied on the date of entry on which share has entered the DMAT account. If share was originally purchased at very earlier it was purchased, we don't have to consider that thing. What we have to check is on what date such share is being entered into DMAT account. That is what matters to us the most. The applicant is applicable in the hands of the beneficial owner. The cost of acquisition shall be decided as per FIFO method. As per CBDT circular, FIFO applied to DMAT securities and not physical securities. See, for physical securities, you already know the cost of acquisition. If multiple accounts are held by SSC, then FIFO should be held account wise. FIFO should be applied account wise. Yes, sir. If, for example, one account I have of Zerodha, the other account I have for Grow. So, account wise, I have to apply FIFO. I cannot cross link the accounts. If any physical securities are dematerialized under FIFO, the basis for determining the movement of the out of the account is the entry into the account. On whatever date I enter into account, I enter such shares into account. That date should be considered while calculating the FIFO. Date of acquisition shall not be considered, rather date of entry of account shall be considered for the purpose of FIFO. Another important provision, what it says: advance money forfeited. Advance money forfeited. See, advance money whenever forfeited shall become taxable. Shall become taxable, no doubt whatsoever. It shall become taxable. Sir, but what matters the most is, sir, if advance money is forfeited on or after 1st April 2014, that is when Modi government came into power. When Modi government came into power, at that time, advance money, if any forfeited, then it shall become taxable under the head income from other sources. It shall become taxable under the head income from other sources. So whatever advance money that has been forfeited shall be taxable under that income from other sources if it has been forfeited on or after 1st April 2024. But sir, if advance money is forfeited prior to that, then earlier it was not taxed under income from other sources. Rather, it was actually reduced from cost of acquisition. It was reduced from cost of acquisition, sir, whatever advance money were forfeiting. Sir, for example, if I have a property, Rahul has property, acquired rupees 10 lakh, I received advance money 50,000. Sales could not materialize. I forfeited that advance money, and now I am selling such property at rupees 30 lakh. Provision says how capital gain will be calculated. Full value will be 30 lakh. Cost of acquisition will be 10 lakh. And sir, whatever the money that you have forfeited prior to 1st April 2012, sorry, 14, prior to this date, then that shall be reduced from cost of acquisition. So my cost of acquisition will be reduced to 9.5 lakh and my capital gain will be arrived accordingly. Did you get this point or not? Did you get this point or not? Sir, whenever advance money is being forfeited by me prior to 1st April 2014, then in that case, such advance money forfeiture shall be reduced from cost of acquisition. That shall be reduced from cost of acquisition. Sir, we got this point. We got this point, sir. We got this point. Sir, but here is a catch. Here is a catch. For example, this is Rahul, and Rahul forfeited the advance money. Rahul forfeited the advance money. And after forfeiture, I gifted this property to my wife. I am the one forfeiting the advance money, and I gave this property to my wife, and my wife sold such property. Sold such property. Oh my God. Oh my dear Lord. Oh my dear Lord. She sold such property. Oh, ho, 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 ho. Sir, for example, my wife sells such property at rupees 30 lakh. Provision says cost of acquisition for her will be cost of acquisition of mine. Whatever cost of acquisition was mine shall become cost of acquisition for her, because ultimately it is exempt transfer on her account. Therefore, whatever the cost of acquisition of previous owner is shall be considered cost of acquisition for her. Therefore, in this case, cost of acquisition shall become 10 lakh. Sir, in this case, 50k advance money shall not be reduced because it has not been forfeited by her now. See, if I would have forfeited advance money and I am selling the asset, then cost of acquisition shall be reduced by such advance money forfeited. But if I have forfeited advance money and my wife is selling such property, then such advance money forfeited shall not be reduced from cost of acquisition. Then in that case, cost of acquisition will become 10 lakh. That is how forfeiture of advance money turns out to be. That is how advance money forfeiture turns out to be. Are we clear with that point? Are we clear with that point? Are we clear? Sir, it's simple. It's not difficult at all. Sir, I have to teach two more special cases. I have to teach two more special cases, but that can be only done after break because those two special cases are not simple in itself, but a bit technical, a bit technical. So right now I am giving you a break. Or should we start with exemptions and then we can continue? Should we start with exemptions and then continue? Should we start with exemptions and then continue? As you say, should we start exemptions or have a break? See, whatever the provision is, it will take at least an hour. Both the provisions will take at least an hour. Let's continue. Okay. Sir, exemptions from capital gain. Sir, I have two special cases I will complete after exemptions. First, let us complete exemptions. They are easier one. See, what we had studied till now is let me brief you once. What we had studied till now, let me brief you once. So we started off with understanding what capital gain implies, basics, definitions. Then we started off with computation. In computation, we studied special points to be considered, full value of consideration, cost of acquisition, or provisos. Then we came on to certain special cases, sir, exceptions to section 45 1, ULIP taxation, slum sale, advance money forfeiture, DMAT securities, 50 AA. We came across very special cases, even though two are left. So then we came on to exemptions. So we have understood computation of capital gain. Now we have to save such capital gain. Now we have to prevent ourselves from taxes. For that matter, we are given certain exemptions, and that exemptions are covered under section 54 series. First of all is section 54. If any individual or HUF, sir, if any individual HUF earns long-term capital gain, on sale of residential house property. On sale of residential house property, provision says that long-term capital gain shall become exempt. That long-term capital gain shall become exempt, provided, sir, you buy one residential house property in India. Sir, one residential house property in India you have to buy, and the thing to be considered is, sir, you have to buy it within 1 year prior to the date of sale. 1 year prior to date of sale you can buy. Within 2 years from the date of sale, or within 3 years you can get that residential house property constructed. So what I'm saying, sell one house property, buy one house property, you will get the exemption. Sell one house property, buy one house property, you will get the exemption. At what time it should be bought? Within 1 year, prior 1 year, within 2 years, or within 3 years, you can get that constructed. Sir, what amount of capital gain will become exempt? Provision is very clear at this point. Sir, whatever the amount of capital gain was, or whatever the cost of new asset is, or 10 crore, whichever is lower will be exempt. Whichever is lower will be exempt. Again, I am repeating this point. Sir, whatever the capital gain amount is, cost of new asset or 10 crore, whichever is lower will be exempt. Also, remember this point. Whenever you are buying certain new house property, whenever you are buying new house property, you must be very careful. Why, sir? Why careful? Because, sir, you cannot sell that house property for at least 3 years. There is a lock-in. There is lock-in, sir. You cannot sell that house property for at least 3 years. If you sell such house property, then exemption claimed earlier shall be withdrawn, and such exemption amount shall be reduced from cost of acquisition of the property. Oh my God. Oh my God, sir, why don't you take an example? Why not? Why not? Sir, for example, if I had a property, say, sold for 50 lakh, and cost of acquisition for such property was 10 lakh rupees, my capital gain was 40 lakh. My capital gain was 40 lakh. Sir, I bought a new house. Oh my God, I bought a new house. I bought a new house. Yeah, 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 yeah. It's a new house for 45 lakh. Sir, capital gain exemption will be capital gain amount 40 lakh or new house, new cost of new asset, whichever is lower. So capital gain exemption will be 40 lakh. The taxable capital gain will turn out to be zero. Taxable capital gain will turn out to be zero. Sir, later on, see what I am required is I am required to at least hold this house for 3 years. Hold this house at least for 3 years. At the end of second year, I decided to sell this house. I got an offer and I sold this house for rupees 80 lakh. Provision says whenever I am selling this house, while computing the cost of acquisition, sir, cost of acquisition was 45 lakh. I have to reduce the amount of exemption that I had claimed earlier. I had claimed exemption of 40 lakh rupees that has to be reduced, and now cost of acquisition will only be 5 lakh. I have to pay capital gain on it later on. What I am saying is, sir, whenever I violate the condition of lock-in, sir, whatever the amount of capital gain was, which was exempt earlier, shall be reduced from cost of acquisition at the time of further sale. Sir, there is a provision. What if I want to save this capital gain again and I bought a new house? I'm buying a new house. Can I buy? Right answer is yes. You can again buy a new house and claim exemption on this 75 lakh. You can again do that. You can continue to do that. You can continue to do that any number of times. It is allowed. So certain special pointers while calculating the exemption. Certain special pointers. Sir, for example, if I have bought two flats, flat number 401, flat number 402. My intention is not to buy two flats. My intention is to buy a bigger flat. It was not available. So I bought two adjacent flats. Why are two different person? Why are two different prices? Why are two different sale deeds? I bought two houses and just broke the wall in between. I just broke the wall in between and reconstructed that flats into single one flat. Will it be considered as one flat or two flat? Right answer is it will be considered as one flat only. If I buy two flats, two adjacent flats from different person, from different sale deed, from different price, at different point of time, it will be considered as one flat. If I broke the wall from the middle and get the two houses constructed as one house, then it will be considered as one house only. Also, sir, if your capital gain is up to 2 crore rupees, if your capital gain is up to 2 crore rupees, then provision says you can buy two houses in a financial year also. If your capital gain is up to 2 crore rupees, then you can buy two houses also in a financial year. But that two houses should be bought only once in a lifetime. Otherwise, sir, 1 year is only one house is only allowed. Normally, you can buy one house whenever you have capital gain on sale of house property. Provision says you can buy two houses once in a lifetime if your capital gain is up to 2 crore. Also, sir, provision says, just imagine, just think of me. I am the one, I am the one who is only because of my mother. From childhood only, she used to feed me. She used to take me to school. Even today, before taking class, she gave me a cup of tea. She make me wake up to take the class. Even today, everything she does is for me. Now, I want to reward her with something. I want to reward her with something. So I bought a new house property and got registered that property in my mother's name. Assessing officer is so bad person that he disallowed the exemption, saying that this property is not in your name, we'll not allow exemption. Oh, shit. No, no, no. How bad that person can be. Assessing officer disallowed the exemption. I am paying money. I am buying the house. Only thing I want to do is get this house registered in my mother's name because whatever she has done to me is invaluable. So I just want this house to be in her name. Assessing officer disallowed the exemption. Arey Baba, why assessing officer is disallowing? Provision says whatever assessing officer is doing is incorrect. If you buy property in somebody else's name, it shall be allowed as exemption. It shall be allowed as exemption. Section 54B, what it says? Section 54B, what it says? Sir, if you have any urban agriculture land, if you are individual or if you are HUF, if you have urban agriculture land, what I'm saying, if you have urban agriculture land and you have used this as land for at least 2 years and that land is being compulsorily acquired, if you have urban agriculture land, you have used that land for at least 2 years and such land is being compulsorily acquired, provision says such compulsory acquisition, the urban agriculture land compulsorily acquired, it is exempt. It is exempt. We have studied this, it is exempt. Sir, but if you have urban agriculture land, you sell it. Will it be exempt? Right answer is no. It will not be exempt, but sir, that is eligible for exemption. See, if urban agriculture land we have, it has been compulsory required, it is exempt. But if urban agriculture land we have and that has been sold by us, which was used by us for at least 2 years, any capital gain arising, whether short term, whether long term, shall be exempt, shall become exempt. So if I buy urban agriculture land or rural agriculture land within 2 years from the date of transfer, within 2 years from the date of transfer, what amount of capital gain exemption I will be getting? Sir, I will be getting whatever the capital gain was or cost of new asset, whichever is lower will become exempt for me. Again, lock-in for 3 years will apply. If I sell any of the asset within lock-in period, then in that case, whatever the exemption claim earlier shall be reduced from cost of asset. I can again in this provision also I can buy property in my mother's name. I can buy property in my mother's name, no issue whatsoever. Sir, what this provision is all about, I am selling urban agriculture land used for 2 years. I have used that land for at least 2 years. Any short-term capital gain and any long-term capital gain arising shall become exempt if I buy urban agriculture land or rural agriculture land within 2 years. Important point to be noted is, sir, even I can buy rural agriculture land. Sir, for example, I had sold an urban agriculture land on 1st April 2024. I was required to buy rural agriculture land or urban agriculture land within 3 years. So I bought this land I bought this land on 1st May 2024. Within 1 month, I bought this rural agriculture land. Within 1 month only, I bought this rural agriculture land. In 1 month only, I bought this. Provision says. Provision says you have to hold it at least for 3 years. But sir, in middle of these 3 years, I sold such rural agriculture land for say 50 lakh rupees. What will happen? Will my exemption claim earlier will be withdrawn? Right answer is. Right answer is. Right answer is. Right answer is. Sir, no. If you had urban agriculture land and you sold it, claimed exemption via acquiring rural agriculture land, and if you sell such rural agriculture land within lock-in period also, you will still be charged with no capital gain taxes. Why, sir? How, sir? Because rural agriculture land is not a capital asset. So even if you violate the condition, government cannot tax capital gain. Oh my God, sir. Oh my God. So is it a kind of loophole? Right answer is yes, it is a kind of loophole. Sir, can we use it in real life? You can use in real life. Sir, is it asked in exam? Right answer is, sir, it has been asked in examination also. It has been asked in examination also, May 25. And it was asked in IBS paper. It was not asked in DT. It was asked in IBS paper. And let me tell you, on the date of examination, a student sent me screenshot of my book only, where I had written this provision previously also. This is not something that we are studying for the first time. We had already covered this provision. And most of the questions that you are going to see in exam are either covered in the book, and all of those provisions are covered in the class. So bhaiya, you can have trust in me. You can have a strong faith in me, strong trust in me. Section 54D. Any person, sir, any person whose land or building of any industrial unit have been compulsorily acquired. Any land or building of industrial unit have been compulsorily acquired, and such land or building have been used by them for at least 2 years prior to the date of transfer. Any long-term capital gain, short-term capital gain shall become exempt. Any long-term capital gain, short-term capital gain shall become exempt. Provision says they have to buy new land or building for industrial undertaking. So they shall acquire within 3 years from the date of receipt of the compensation. So as soon as they receive compensation, they have to buy such new land or building within 3 years. Sir, whatever the capital gain amount was, or sir, cost of new asset shall lower of them becomes exempt. Again, lock-in for 3 years apply. If they sell such land or building within 3 years, then that exemption claimed earlier shall be reduced from cost of acquisition. Sir, section 54 EC. Section 54 EC, sir, very important section. Important for all of you. Important for all of you and for all SSCs, because sir, it is only section available for every SSC so that they can claim exemption. If a company want to claim exemption, they cannot claim exemption in any section except for 54 EC. Sir, if any person earns long-term capital gain on transfer of immovable property, earns long-term capital gain on transfer of immovable property, but I should say, if any of the person transfers long-term capital asset, if any of the person transfers long-term capital asset, capital gain may be long-term, but normally it can be anything else also. Capital gain may be long-term, but it can be anything else also. What he has to buy? Provision says it has to buy, sir, 5-year redeemable bonds of National Highway Authority of India, 5 years redeemable bond of Rural Electrification Corporation Limited, 5-year redeemable bond of Power Finance Corporation Limited, 5-year redeemable bonds of IRFCL. Sir, also with effect from 1st April 2025, a person can buy bonds of HUDCO. You can write it down, sir. 1st April 2025, this provision is applicable. If your attempt is in Jan 26, then you may be asked with this point, HUDCO, you can buy the bonds of HUDCO for 5 years. 5 years redeemable bond of HUDCO you can also buy. Sir, what is the amount of exemption? Sir, you have the amount of exemption is, sir, capital gain amount, cost of new asset, but subject to maximum 50 lakhs. Sir, maximum 50 lakh exemption is allowed under section 54 EC. Sir, within date of transfer, we have to acquire such assets within 6 months, provided that we can never sell those bonds. We can never sell those bonds, nor we can convert it into money. If we intend to convert into money implies, sir, if I have certain bonds, can I mortgage such loans, such bonds and get loan in return? Provision says no. Provision says no. If you have any money, if you have any bond, you can neither convert it into money nor you can sell them. Otherwise, exemption claimed earlier shall become taxable. Sir, two to three important points to be understood. Sir, first of all, just imagine, for example, I had sold asset on 1st April 2024. I have to acquire bonds within 30th September 2024. I have to acquire it within 6 months from the date of transfer. I paid consideration on 28th September 2024 and I got allotment on 11th November 2024. See, I paid consideration within time, but bonds are not allotted within time. So will I get exemption or not? Right answer is I will get now. I will get now. Logically speaking, whatever is in my hands, whatever is in my hand, I have done that. I could only do the investment amount. Allotment is not in my hands now. Allotment is not in my hands now. So ultimately, I paid consideration within 6 months. Provision says you will be allowed exemption, even if allotment is done after 6 months, even if allotment is done after 1 year. At any point of time, allotment is done. It is not relevant. I just have to pay the consideration within 6 months. Also, sir, there was a case law. There was a case law of VS Demco Limited at Supreme Court. Case law was VS Demco case law at Supreme Court. Sir, what was the case law? Let us understand it. In a simplest manner. In a simplest manner, let us understand it. Sir, if we have a building which is depreciable asset, building is a building is a depreciable asset. If I transfer such building, sir, capital gain will be short-term capital gain. Any transfer of any transfer of depreciable asset will yield a short-term capital gain. But sir, this depreciable asset is a long-term capital asset. So there is a difference. Asset can be long-term, but it can yield short-term capital gain. Apart from ordinary parlance, whenever we have long-term capital asset, it will yield us long-term capital gain. But sir, there are certain exceptions. Sir, not every long-term capital asset will give us long-term capital gain. For example, depreciable assets. Whenever we sell depreciable assets, we will get short-term capital gain. Whenever we sell any securities referred under section 50 AA, we, despite of having long-term capital asset, we get short-term capital gain. So there are situations where, despite of long-term capital asset, we end up having short-term capital gain. Sir, will exemption be allowed under section 54 EC on transfer of this land? So it is a long-term capital asset. It is a long-term capital asset, but capital gain is short-term. Whether section 54 EC be allowed against this capital gain? Whether section 54 EC be allowed against this capital gain? Whether exemption under section 54 EC be allowed against this capital gain? Sir, right answer is it will be allowed. Supreme Court, in case of VS Dempo, interpreted this fact that capital asset has to be long term for claiming exemption under section 54 EC. Sir, capital gain lead can be anything. Capital gain can be long term capital gain can be short term capital gain. What matters is whether capital asset is long term or not. What matters is capital asset has to be long term. Based on that, we will be awarded exemption. I hope things are clear. I hope things are clear. Sir, if you are following my book, you may write the name of the case law. Earlier, I don't used to write the name of the case law, but right now I think it is important. If it is being asked in exam, you should be able to quote the case law. VS Dempo, Supreme Court case law. Nothing else you need to remember in this case law. Sir, I want you all to have a break. It's 9:28. We have a break till 9:50. I normally give long breaks because I want you all to rejuvenate properly. See you guys after the break. After break, we'll continue with exemption 54F. We'll continue the transfer from partnership firm to partner in case of reconciliation. It is a beautiful provision. See you all after the break. And even also, if possible, bring a friend with you. Bring a single friend with you. It will definitely help us to capitalize these resources in best efficient manner. See you guys after the break. Okay, so welcome back from break. Are you all back from break? Just let me drop a message once. Yes. Okay. So before going to break, we started off with exemptions. We started off with exemptions under section 54. We completed it. Started off with 54B, 54D, and 54EC. We completed all these four exemptions. Let's complete exemptions first. Then we can move forward to partnership form to partner transfer. Sir, section 54F. What it says if any individual or HUF, if any of the individual or HUF transfers any asset other than residential house property. Sir, it can be any commercial property, it can be any land, it can be gold, it can be shares, it can be debt oriented mutual funds, it can be equity oriented mutual funds. Any asset which is not residential house property can be transferred. That asset should be long term capital gain. Sir, that asset should be long term capital asset. Capital gain may be long term, may be short term, that is not relevant. Sir, capital asset should be long term. And sir, what he buys one residential house property in India. If he buys one residential house property in India, sir, within 2 years, or he constructs within 3 years, or he buys 1 year prior to date of transfer, then in that case, sir, he will be allowed an exemption. And sir, exemption will be allowed in a proportionate manner. So whatever the long-term capital gain is, that shall be multiplied by cost of new asset divided by some net consideration. In this ratio, he will be allowed exemption. Government's intention is very clear that out of the net consideration, the more he invests in the new asset, he shall be given exemption to that extent. In the proportion of cost of new asset to net consideration, he shall be allowed exemption. Okay, sir, we got that point. So remember, we need to remember this point, that maximum exemption under section 54F that can be claimed is 10 crore rupees only. Maximum exemption that one can claim under section 54F is 10 crore rupees only. Simple provision. Sir, again, the lock-in period applies same as it is. We have to hold such asset for at least 3 years. If I sell such asset within 3 years from the date of acquisition, then in that case, any exemption claimed earlier shall become taxable. Sir, if I buy any property, sir, I can have 50% of the property registered in somebody's else name. For example, if I and my wife jointly buy the property, I pay the entire consideration and get it registered 50% in the name of my wife, I can still claim 100% exemption. What matters is if you are paying the consideration, then you will be eligible for exemption. Sir, for example, I am just constructing house within 3 years. My complete construction is done. Only a few petty work is pending, like floors and fittings, tiles fittings, POP is pending, or sir, many of petty works are pending. For example, lighting vagara is pending. So, sir, this petty work does not invalidate the proceedings, or this does not invalidate the exemption. Provision says if petty work is pending, it is assumed that construction is done within 3 years. Exemption, you will still be given exemption. You will still be given exemption. Also, provision says, sir, if you have any one residential house property in India, prior to claiming exemption, it is allowed. But if you have more than one residential house property, here, what is the net concession? I'll tell you. Okay, I'll tell you. Provision says if you are claiming exemption under section 54F, you can only have one residential house property prior to claiming exemption. That means after claiming exemption, you can only have two properties. And sir, once you have two properties, you can not claim exemption under section 54F again. You need to have only one residential house property before claiming section exemption under section 54F. Either no property or one property. If you already have two properties, two house properties, then in that case, you will not be able to claim exemption. So this point is very, very super clear. Very, very super clear. Very simple point. Arjun asks, what is the net consideration, sir? What is net consideration, sir? Sir, for example, if you sold house for rupees 50 lakh, you paid transfer expenses of rupees 1 lakh. All in all, your net consideration is 49 lakh. Net consideration is 49 lakh. You bought a new house. Sorry, cost of acquisition of that house was 30 lakh. Your capital gain turns out to be 19 lakh. See, exemption allowed will be, sir, LTCG multiplied by net consideration divided by net consideration multiplied by cost of new asset. So, for example, if I buy a new asset worth rupees 30 lakh, net consideration was 49 lakh, capital gain was 19 lakh. So in this ratio, out of the 49 lakh rupees worth of net consideration, I am applying only 30 lakh rupees. Therefore, in this proportion only, my capital gain will become exempt. In this proportion only. Out of the net consideration, whatever I am applying for new asset, then only it shall be that amount only shall be considered as exempt amount. Rest all will become taxable. Okay. Provision was simple. This was all about section 54 exemption. Perfect. Sir, I had a doubt. Sir, what if I have market linked debentures? If I have market linked debentures, sir, if I transfer such market linked debentures, will I be able to claim exemption? Will I be able to claim exemption under section 54F? Right answer is yes, you can claim that. The only condition to be satisfied is you must have asset which is long-term capital asset. Asset must be long-term capital asset, sir. It is not relevant that whether capital gain is short-term or not. You must have capital asset as long-term capital asset. So you can even claim exemption on unlisted bonds and debentures. If such unlisted bonds and debentures are long-term unlisted bonds and debentures, you can still claim exemption on those assets, despite of the fact that capital gain will be short-term. Capital gain is not relevant, sir. Capital asset has to be long-term. Section 54G and Section 54G almost talks about similar things. What it says. Provision says if any person. In both the cases, it says any person. So transfers land, transfers building, transfers plant and machinery of industrial unit of urban area, transfers land, transfer building, or transfer plant and machinery of industrial unit of urban area. In both the cases, land building of urban area is being transferred. Arjun, they are not deemed to be STCA. They are not deemed to be STCA. They are deemed to be STCG. Capital gain arising on such assets are always, see what Arjun is asking. Very good question it is. Arjun says, if I sell any market linked debentures, they are considered as short term capital asset. Right answer is no. No. If you sell any market linked debentures, if you sell any specified mutual fund, if you sell any unlisted bonds or debentures, those might still be considered as long term capital asset. But capital gain will be short term. Capital gain on account of such assets will be always short term, but capital asset might be long term. Capital asset might be long term. Capital asset depends upon period of holding. Okay, 50G and GA. Sir, if we have land, building, plant and machinery of urban area, land, building, plant and machinery of urban area. In both the cases, 50G and GA, we have land, building, plant and machinery of urban area. Important point to notice. Sir, whether long-term capital gain is, whether short-term capital gain is, in both the cases, sir, we do not have furniture. In both the cases, we are not allowed any exemption on furniture. Furniture is not allowed. Sir, from urban area, under section 15G, we have to shift to rural area. And under section 54GA, from urban area, we have to shift to SEZ. From shifting urban to rural, we have to acquire some new plant and machinery, land or building to claim exemption. But sir, while shifting from urban to SEZ, we can have second-hand plant and machinery and sir land and building to even claim exemption. Okay. Time limit is either the date of transfer prior 1 year prior to date of transfer, or within 3 years from the date of transfer we can acquire such land, plant and machine. Sir, whatever the capital gain is or whatever the cost of new asset is, whichever is lower will be exempt for us in both the cases. Sir, if we violate any condition within 3 years from the date of the acquisition, then in that case, whatever exemption claimed earlier was will be withdrawn. Almost similar section, but what they talk about is 54G talks about we are shifting our businesses from urban area to rural area. 54GA talks about we are shifting from urban area to SEZ. 54G says you have to buy new plant and machinery. 54GA stock talks about you can buy second hand plant and machinery also. In both the cases, so exemption on capital gain on furniture is not allowed. Rest all short term capital gain, long term capital gain, you can claim exemption. So what happens is in all the sections we have studied that government allows us to buy asset within 3 years or get constructed within 3 years. Government allows 3 years. However, government know that whether we are buying it or not. We may claim exemption and never buy asset eventually. Provision says to curb such practices, to control such practices, government made an account called Capital Gain Account Scheme, CGAS scheme. Provision says, first of all, whenever you have capital gain, sir, you have to either buy asset up to the date of ROI. If you are not able to buy asset up to the date of ROI, deposit the relevant capital gain amount to such CGS account. And whenever you want to buy asset, then you can buy from that money. Whenever you want to buy such asset, you can buy from such CGS account. You can withdraw money from that CGS account and then buy accordingly. So that government has a proper track on the money that you are using, whether you are using it or not. If you are misutilizing it, in that case, it becomes taxable in the year in which you were supposed to utilize. Also, there was a section to reduce the complexity of the Amaravati. See, this has been the worst section that I have ever studied. It is not worse because the provision is worse, but it is because it makes me feel sad about people. Section 37A talks about how government of India brought exemptions for the people of Amravati. See, Amravati is situated in Andhra Pradesh as of now. Amravati is situated in Andhra Pradesh. Sir, few years back, Telangana got split from Andhra Pradesh, and Amravati was Telangana got the capital, Hyderabad. Hyderabad was transferred to Telangana. Right now, Andhra Pradesh does not have any own capital. So, Chief Minister at that time, I guess it was Y.S. Jagan Mohan Reddy. Oh no, Chandrababu Naidu at that time was the Chief Minister. He decided to make Amravati their capital. For that matter, what he did, he took the fertile land of the farmers and wanted to make such city better than Singapore, better than Dubai. He wanted to make that city better than Singapore, better than Dubai. For that matter, he took the fertile land of the farmers. And what farmer were given? Farmer were given just a promise. A promise that a flat, a building, a bungalow will be given to them as soon as city is accomplished. As soon as development of city is done, they will be given a flat, a bungalow, or a house. Just imagine, think of a state of mind of a farmer who just have their agricultural fertile piece of land which was compulsorily acquired by government. Shouldn't that be capital gain? Provision says that there will be no capital gain on giving this property to government. They were given a promises called LPOCs, land pooling ownership certificates. That promise was that whenever property will be constructed, they will be given a share in that. That LPOCs were given to them. Provision says there will be no gift taxation in case of LPOCs. No 56 student would apply. These farmers, whenever they intend to sell such LPOCs, they can sell at whatever price they want. That capital gain on transfer of LPOCs will always be exempt. If in case farmers are allotted such houses against such LPOCs, transfer on any such houses will be exempt up to the 2 years from the end of the year in which houses are allotted. For example, if a farmer is allotted a house in Amaravati, so for this year and 2 years from the end of this year, if I transfer such house, it will always be exempt. If I transfer my house during this year, in the year in which I am allotted, or if I transfer my house within 2 years from the end of the year in which I am allotted, it will be exempt. But if I transfer it after end of the 2 years, then in that case, whatever the STV as on the end of the 2 year will become cost of acquisition. So this has never been asked, and I seriously doubt that this will ever be asked in exam. That completes our exemption portion. Sir, why not to complete tax rate also? Then we can come to partnership firm to partner. Why not to complete tax rates also? It will give us a more edge. Almost our chapter will be over. We'll be done with. We'll be only left with only two topics. Sir, tax rates. Sir, basically, what tax rates are all about? Sir, we have four sections. We have four sections for taxing income. We have four sections of taxing income. Not actually four, but basically we have three sections only. We have only three sections of taxing and income. Sir, first of all is section 112A. Section 112A, which talks about listed equity shares, listed equity oriented mutual funds, and listed units of business trust. What it says: if any of such securities are sold and we have long term capital gain, then it will be taxable under section 112A. Tax rate would apply. So over and above 1.25 lakh of capital gain, we will be taxed at the rate 10% if transfer take place prior to 23rd July. And if transfer take place after 23rd July, then we will be taxed at the rate 12.5% over and above 1.25 lakh. This is 112A. Similarly, if we have assets covered under section 111A, that is equity, listed equity shares, equity oriented mutual funds, or units of business trust which are held for less than 1 year, then in that case, if they are transferred prior to 23rd July, tax rate will apply 15%. If it is transferred after 23rd July, then tax rate will apply 20%. So if we have any immovable property, any other asset on which we earn long-term capital in under section 112, tax rate at 20% apply prior to budget, or if it is transferred after 23rd July, tax rate will apply 12.5% after budget. Before budget is 20%, after budget it is 12.5%. And if you have any other STCG, tax rate will apply at the rate of slab before and after budget. This is the broad idea. I want to cover each topic in depth. Section 112A. What section 112A? Sir, if we have any long-term capital gain on, equity shares on which STT has been paid at the time of acquisition and at the time of sale. If we have any equity oriented mutual fund on which STT has been paid at the time of sale, and if we have units of businesses on which STT has been paid at the time of sale, will be taxable at the rate 10% or 12.5% over and above 1.25 lakh. Sir, what I am saying, just listen carefully. If we have any equity shares on which STT has been paid on acquisition and transfer, if you have any equity oriented mutual fund on which STT has been paid on transfer, or if you have any unit of businesses on which STT has been paid on transfer, sir, shall be taxable at the rate 10% if such asset has been transferred before 23rd July, and taxable at the rate 12.5% if it has been transferred on or after 23rd July over and above 1.25 lakh. Sir, 1.25 lakh will be completely exempt. Then whatever gain turns out to be, we have to check on what date such asset has been transferred. We will be going to tax accordingly such asset. We are going to tax such asset accordingly. Sir, provision clearly does not states whether such securities are to be listed or not. Provision does not states that securities are to be listed or not. Provision simply states STT has to be paid on such securities. See, provision states STT has to be paid on securities. Security transaction tax has to be paid on securities. Provision does not say it must be listed. But sir, STT is only applicable when securities are listed. So indirectly, we can conclude that securities are to be listed. Security are to be listed to get benefit under section 112A. To claim benefit under section 112A, securities are to be listed. But there are two exceptions to these provisions. See, there are cases where even if you don't pay STT, you will still be allowed this benefit 112A. Even if you don't pay STT, you will be allowed. Sir, what are those cases? First of all, sir, you bought securities even when STT was not even applicable. See, STT security transaction tax came on 1st October 2004. If you had acquired such assets prior to that, then you must have not paid STT. So in that case, you will still be allowed exemption despite of the fact you have not paid STT. Okay. Second case, securities on which STT is not even applicable. For example, if you buy securities on an IPO, in case of IPO, you are not required to pay any STT. If you buy any ESOP, in that case, you are not required to pay STT. Even if you have not paid STT, you will still be given benefit under Section 112A. And third thing, if you buy securities at recognized stock exchange and IFSC, then in that case, you will still be allowed benefit even if you have not paid STT. So three cases where even if you don't pay security transaction tax, you will still be allowed benefit under Section 112A. Three of them is, sir, first of all, you have acquired shares prior to the date STT came into force. Second thing, sir, you have acquired shares on after 1st April, 1st October 2004, but STT is not even applicable. For example, IPO or example, if shares are bought in sweat equity shares, ESOP pools. And third thing, if trading takes place at recognized stock exchange and IFSC, in these three cases, even if you have not paid STT, you will still be allowed. You will still be allowed this exemption under Section 1, sorry, this benefit under Section 112. Also, also, there are three cases where even if you pay STT, even if you pay security transaction tax, you will still not be allowed benefit. See, STT has to be paid. Three cases where even if you don't pay STT, you will be allowed. Now, three cases where even if you pay STT, you will still be not allowed benefit. You will still be not allowed benefit. Sir, what are those three cases? First of all, you are buying and selling shares which are not frequently traded. You are buying and selling shares which are not frequently traded. Sir, for example, if you see Porval Auto Component Limited, Porval Auto Component Limited, sir, that share is being traded at just rupees 1. No trading ever takes place in that share. Provision says if you buy that security and sell that security, you will not be allowed benefit under Section 112. See, that securities are not frequently traded. In that case, you will not be allowed any benefit under the section. Also, Second, sir, provision says if any HNI, if any QIB, if any person buys or sells such securities on account of SEBI order, on account of NCLT order, on account of High Court order, then in that case they will be allowed exemption. They will be allowed this benefit. But a normal person who buys securities which are not frequently traded, he will not be given any benefit. Second exception, where you even pay STT, you will still not be allowed exemption. Second case, what is the second case? Sir, you buy share otherwise than recognized stock exchange. For example, if I buy shares at Chennai Stock Exchange, if I buy shares at Kolkata Stock Exchange, even if I pay STT now, I will still not be allowed. I will still not be allowed to claim benefit under Section 112. See, if I buy shares otherwise than a recognized stock exchange, then I will not be allowed benefit under Section 112. But again, there are certain exceptions. If we have any QIB, if somebody is buying on account of Supreme Court order, High Court order, somebody is buying on account of NCLT order, SEBI order, somebody is buying ESOP, somebody is acquiring from the government, somebody is acquiring in case of slum sale, any investment fund is acquiring, they, even if they don't acquire by recognized stock exchange, they will still be allowed benefit under Section 112A. So last one is, sir, if somebody buys any shares after delisting of a company, see, if a company is delisted, provision says if you buy any securities after delisting, but prior to relisting, after delisting and prior to relisting, if you buy such securities, that means that intervening period at the time at the time when securities were unlisted, in that case, you will still not be allowed 112A ka benefit. You will still not be allowed 112A benefit. So what I said, see, to claim benefit under Section 112A, you must have paid securities. Sorry, you must have paid STD. But three cases where you, even if you don't pay STD, you will still be allowed benefit. So what were the three cases? Sir, you bought securities prior to STD coming into force. Second thing, you bought securities on which STD is not even applicable. And third, you bought securities at recognized stock exchange and IFSC. Sir, even if you pay STT, even if you don't pay STT, you will still be given benefit. Three cases where even if you pay STT, you will not be allowed benefits. Sir, what are those three cases? Provision says you are buying shares which are not frequently traded. You are buying shares from other than recognized stock exchange, or you are buying shares at the time of intervening period from delisting to relisting. In that case, it will not be allowed. Also, if somebody buys any securities on account of SEBI order, High Court order, NCLT order, Supreme Court order, they will still be allowed some benefit. Okay, sir, we got this point. Important point to note. Important point to note. Sir, important point to note. Sir, what important point is? Sir, whenever you sell any securities that are covered under section 112A, you are given a benefit of increased cost of acquisition. You are given a benefit of FMV as on 31st Jan 2018 to be taken as your cost of acquisition. You are given a benefit of FMV to be taken as your cost of acquisition. You are given a benefit. Sir, why that benefit is given? See, there were multiple reasons for that. Let's not get into the details why FMV was given. Just we can assume that FMV benefit is given to us. Just assume that FMV benefit has been given to us, because of which, sir, we are required to pay capital gain taxes on a lesser amount. Okay. Sir, important thing is whenever we have any securities on which STT has been paid or that are listed on recognized stock, that are listed, in that case, instead of taking cost of acquisition, we have to take actual cost of acquisition or FMV as on 31st Jan 2018, whichever is higher. We have to take actual cost of acquisition or FMV on that date, FMV on 31st Jan 2018, whichever is higher. But remember, FMV cannot exceed sales value. FMV cannot exceed sales value. Remember, FMV cannot exceed sales value. Okay. So how FMV has to be calculated? You just check whether such securities that you are transferring, are listed on 31st Jan 2018. If such securities that you are transferring are listed on 31st January, take the highest trading price now. Take the highest trading price. If such securities are listed, just take the highest trading price on 31st Jan 2018. That will be the FMV. Simple point it is. If no trading has taken place, take the highest trading price of the last trading session whenever time trading has took place. Simple point. How to compute FMV? Sir, if shares are listed, if units are listed, if mutual fund units are listed, just take the highest traded price on the date of 31st Jan. If shares are listed on 31st Jan, then only we can take highest traded price now. But sir, what if units of mutual funds or units of businesses are not listed? What to do? So for mutual fund, what you can do? For mutual fund, you can take NAV, net asset value, as on 31st Jan 2018. But sir, shares or business trusts, sir, which are not listed on 31st Jan but got later listed, in that case, you can take index cost of acquisition. You can take cost of acquisition divided by CII of year of acquisition multiplied by 272, that is CII of 1718. This will give us inflated cost of acquisition. This will work as FMV as on 31st Jan 2018. You can compare it with sales value and then take actual cost of acquisition, whichever is high. Basic provision it is. I don't think this will worry you a lot. The basic provision is whenever your shares are listed as on the date of sale, you are given a benefit of FMV as on 31st Jan 2018. Now, how FMV is calculated? If shares are listed on that date, just take the highest traded price. If shares are not listed, if shares are not listed, then in that case, what to do? In case of mutual fund, just take the NAV. In case of any other shares or businesses, just take the index cost of acquisition up to 2017-18, previous year 17-18. That is how you will take the cost of acquisition in these special cases. Sir, what is an equity oriented mutual fund? Provision says if I have any mutual fund and whatever proceeds I have, provision says is out of that proceeds, 65% of the proceeds are being invested in listed equity shares of a domestic company, then in that case it is considered as equity oriented mutual fund. Similarly, if I have certain money which I can invest and 90% of my money are being invested in any of other mutual fund, which in itself, out of the total proceeds, 90% invest in any equity shares of a domestic company, provision says, then in that case, I will be considered as equity oriented mutual fund. What I'm saying, if I directly invest 65% or more in listed equity shares of a domestic company, I am equity oriented mutual fund. But sir, if I am investing in another mutual fund and that another mutual fund in itself is investing 90% of its proceeds in equity shares of domestic company, I will be considered as equity oriented mutual fund indirectly, but still I will be considered as equity oriented mutual fund. Are we clear with this fact? I want to know, are we clear with this fact? Are we clear with this fact, sir? What is an equity-oriented mutual fund and how taxation take place under section 112A? How you have to check whether securities are listed or not. For that, you have to check STT. STT sometimes even paid, not we'll not get benefit. Even if not paid, we'll get benefit. There are certain exceptions to that. We studied that point. How to consider cost of acquisition? We studied that point. Are we clear with that? Are we clear with that? Yes, sir. Absolutely clear. Yes, sir. Now, sir, section triple one. See, provision says if you have any short-term capital gain, if you have any short-term capital gain on again equity shares that are listed, any kind of equity-oriented mutual funds on which STT has been paid, any kind of units of businesses on which STT has been paid, that shall be taxable at the rate 15% if they are transferred prior to 23rd July. That shall be taxable at the rate 20%, sorry, 15% prior to 23rd July and 20% after 23rd July. If such assets have been sold on or after 23rd July, then it shall be taxable. Then it shall be taxable at the rate 20%. That's simple. Whatever share, whatever securities that are covered under section 112A, similar securities are covered under section 11118. Other SCCG, if you are selling any other asset and incurring any short-term capital loss, short-term capital gain, that shall be taxed at the rate slab. Sir, for example, gold, if I'm buying today, selling tomorrow, whatever capital gain I will be earning, that will be short-term capital gain, that will be taxed at slab. Sir, in case of capital gain, long-term capital gain, other than 112A, this is very important section. This is very important section, and that has undergone remarkable changes. This has undergone remarkable changes. Before referring anything in this book, I just want to take you to through the notes and jot it down whatever I'm saying. Sir, what earlier provisions were prior to 23rd July with effect from 23rd July? Sir, earlier, if any SSC incurred CG under section 112, he was taxed at the rate 20%, but he was allowed indexation. He was allowed indexation. Nimotai said, I don't understand these provision. I don't understand these provision. 12.5% flat, 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 no indexation, no indexation, no indexation. Oh my God. Oh my God. If any SSC sold any asset that are listed and not covered under section 112, shares that are listed and are not covered, shares that are listed and are not covered under section 112. So if somebody is selling such assets, if somebody is selling such assets, then what to happen, what to do? If you sold any assets that are listed but are not covered under section 112, then assessee was allowed 10% without indexation, 20% with indexation, whichever is lower. Nemotai says, I do not understand, I do not understand, I do not understand. Sir, with effect from 23rd July, 12.5% flat, no indexation. Earlier, what used to happen? Any SSC, any SSC, any SSC who was non-resident or foreign company used to invest in unlisted shares of Indian company. They were leviable to tax at the rate 10% without indexation. Nemotai says, I do not understand this difference. I do not understand this difference. You urban Naxal, you anti-national, how can you pay these taxes? I am increasing 12.5% tax without indexation. Flat, no indexation. Any Am I very much clear with this fact that earlier we used to have indexation? For that matter, capital gain was high and we were allowed higher tax rate. But right now, since the indexation has been scrapped, capital gain is taxable at a lower rate. Capital gain is taxable at a lower rate. Okay, are we clear with this point? Are we clear with this point? Yes or no? Yes or no? Are we clear with this point? Okay. Sure. See, if any SSC used to sell any kind of land or building, any kind of gold, any kind of debt oriented mutual fund, he was allowed indexation. He was allowed indexation for capital gain computation, and later on, he was taxed at a higher rate, that is 20%. Before 23rd July, this was the case. But later on, what happened was, Nimota said, I don't want to charge any, I don't want to give any indexation. You will be charged at flat 12.5%. We are not giving any indexation after 23rd July. Therefore, capital gain amount would increase and tax would be charged at the rate 12.5%. Similarly, if any SSC who had long-term capital gain on any listed securities which are not covered under section 112A. For example, sovereign gold bonds are listed, ETFs that are listed securities. So we can have any kind of SME IPOs. So these are listed on which STT is not required to be paid. Provision says you SSC was having an option prior to 23rd July that he can pay 10% taxes without indexation or 20% with indexation, whichever is lower. But subsequently, it was changed to flat 12.5% with effect from 23rd July. Similarly, if a non-resident or a foreign company used to invest in unlisted shares of Indian company, they were taxed at the rate 10% flat. But this tax rate was increased. This tax rate was increased to 12.5% with effect from 23rd July. Correct. These were the tax rates prior 23rd July under section 112, and these were the tax rates with effect from 23rd July under section 112. But sir, here is a catch. Here is a catch. If any individual, if any individual, not actually individual, but sir, if any resident individual oblique HUF transfers immovable property acquired prior to 23rd July 2024, sold on or after 23rd July, tax shall be calculated as if 12.5% without indexation or 20% with indexation, whichever is lower. Oh my God. So this was the amendment in Finance Act 2024. I will give you an example which will make it crystal clear. I will give you an example which will make this concept crystal clear to you all. Just understand this. Just understand this, what I'm saying. For example, we have Mr. Arjun, bought house worth rupees 10 lakh on on 1st April 2001 and sold it for 40 lakh on case 1 22nd July 2024. Case 2, 24th July 2024. Compute capital gain and compute the taxable amount. Just understand this. Just understand this. Sir, full value of consideration in both the cases will turn out to be 40 lakh. We don't have transfer expenses in both the cases, therefore net consideration will turn out to be 40 lakh. Cost of acquisition, sir, since asset is sold, in case 1, asset is sold prior to 23rd July, so we will be allowed indexation. We will be allowed indexation. Sir, 10 lakh is the cost of acquisition divided by CII of year of acquisition. Sir, previous year, CII of previous year 1, 2 is 100 multiplied by CII of year of transfer, that is 363. In this case, cost of acquisition turns out to be, index cost of acquisition turns out to be, so 36.3. Taxable capital gain will turn out to be 36.3. That this implies 37. Taxable capital gain will turn out to be 3.7 lakh. In case 2, sir, since I am selling the asset after budget, I am selling the asset after budget. So no indexation will be allowed. My capital gain will turn out to be 30 lakh. Sir, are you understanding the difference? Just because of this indexation clause, earlier capital gain, which would have been 3.7 lakh, now increases to 30 lakh rupees. Earlier, I was charged tax at the rate 20% on this. Now I will be charged at the rate 12.5% on this. This is the change. But sir, if there is an individual, if Arjun is an individual, a resident individual, or HF, plus he acquired immovable property prior to budget, prior to 23rd July 2024, and sold thereafter. Sir, Arjun is an individual, yes. He acquired property prior to 23rd July, yes. Did he sell after budget? Yes. So all the conditions are fulfilled. So tax calculation will be done lower off. So tax calculation, how tax calculation will be done? In case 1, it will be flat 20%. In case 1, it will be flat 27%, 74,000 tax plus 4% education cess. 76,960 will be tax calculation in case 1. Sir, flat 20% will apply prior to budget. But after budget, sir, if you are individual HF, if you are resident, you are acquiring immovable property prior to budget, selling thereafter, you will be given a benefit. What benefit? Sir, tax at the rate 12.5% on 30 lakh. That is 3,75,000. Or tax at the rate 20% on, sir, 40 lakh minus 10 lakh divided by 100 into 363. That is 36.7 lakh, 36.3 lakh. That is 3.7 lakh. Tax rate on 3.7 lakh on 20% will be 76,000. So tax rate, whichever is lower, will apply. In this case also, tax rate will remain same. Tax amount will remain same. See, if assessee would have been any other person like company, if assessee would have been any other person like company, firm, LLP, then this benefit would have been not available. This benefit would have not been available. This benefit would have not been available. But if you are an individual or HF, that too resident, that too acquiring it prior to 23rd July and selling it thereafter, you will be given a benefit in tax calculation. Sir, are you given benefit on capital gain computation? No, you are not given any benefit in computation. You are just given a benefit in tax calculation. Sir, tax calculation benefit, which ultimately yields out the same tax, but it is only benefit given to individual. If you would have been a company, if Arjun would have been a company, then in that case, Arjun was required to pay tax at the rate, sir, at the rate of 12.5% on this 30 lakh. This is the change in the finance side. I hope things are very clear. Thanusha Lakshmi says, sir, please can you tell me how to purchase this English batch? Thanusha, the video that you are referring has a description box. In this description box, first link has been given of this batch. First link has been given. Okay. You can visit that link in the description box, or I am giving you a mobile number. You can talk to that team. They will provide you access to the link. Just give me a second. I will give you a mobile number: 9200 9200 7900. You can call on this mobile number. They will guide you how to buy this lecture. The easiest thing is you can go visit the link. You can visit the link given in description box. Second thing, if you don't want to visit, you just want to talk to team how much this batch is going to be, what all queries you want to have, you want to ask, you can ask on this number. They will respond you accordingly. Okay, sir, we got this point. We got this point. Sir, are we clear with what the tax rates are under section 112? Yes, sir, absolutely crystal clear. Absolutely crystal clear. Sir, we must remember, sir, no deduction under chapter 6A shall be allowed on the sum or on the income above. Sir, if we have any income taxable under section, if we have any income taxable under section 112A, 112, 111A, no deduction under chapter 6A will be allowed. No 80C, no 80G, no 80GGA, nothing will be allowed. No 80IA, 80IAC, nothing will be allowed against these special tax rates income. Sir, if we have unexhausted basic exemption limit, if we have unexhausted basic exemption limit, then too we cannot set off such unexhausted basic exemption limit against. Can we set off? Right answer is we can set off. See, for example, if an SSC has other income of 1 lakh, capital gain income of 2 lakh, winning income of 2 lakh. This capital gain is income is taxable at the 20%, winning is taxable at 30%, this 1 lakh is taxable at slab. Can I simply say that he has 1.5 lakh rupees worth of basic exemption limit left? His basic exemption limit is 2.5 lakh or 3 lakh, as the case may be. He has unexhausted basic exemption limit. Can he set off this basic exemption limit against this capital gain? Can he set off this basic exemption limit against winnings? Right answer is, sir, if you are a non-resident, no set off allowed. No set off allowed. If you are a non-resident, no set off allowed. Against any income, you cannot set off basic exemption limit. Whatever the special tax rates you are earning, you have to pay taxes on that income. No set off of basic exemption limit is allowed. But if you are a resident person, then you have to check. Sir, basic exemption limit is allowed to be set off against 112A, 111A, 112. It is allowed. But sir, for resident even, it is not allowed for winnings. It is not allowed for online gaming, or I should say any other income. It is not allowed. So sir, for example, if I have other income of 1 lakh and I have winnings of 2 lakh, my total basic exemption limit is 3 lakh rupees, out of which 1 lakh is the other income. So 2 lakh is unexhausted. Can't I use this 2 lakh to set off my winning income? Right answer is no. Only income that you can set off against this basic exemption limit is these 3 incomes. That too only resident person can do, non-resident person cannot. Do. Sir, you can only set off against this 2 lakh, against these 3 capital gain income. You cannot set off this basic exemption limit with any other income like winning or any other income. You cannot set off. Are we clear with that fact? Yes, sir, we are very much clear. When a stock can be considered as capital asset, or stock in trade. If I have securities, if I have, for example, debentures, if I have shares, when do I consider it as stock in trade? When do I consider it as capital assets? So how do we know? That is it a capital asset or is it a stock in trade? Provision says CBDT has devised certain terminologies. CBDT has devised certain methods through which they can decide. First of all, how assessee treats such securities in his books of accounts. That is the first and the foremost important thing. If assessee himself treats it as capital asset, as AO has to assume it as a capital asset. Assessee himself treats it as stock in trade, AO cannot argue. Second thing, what is the holding period that assessee has? If assessee is holding such as securities for more than 2 to 3 years, 4 years, 5 years, 10 years, it is always capital asset. But if he is holding for less than 1 day, 2 day, 3 day, 4 day, then it might become stock in trade. Third thing, quantum of purchase and sales. Assessee just purchases the asset, he never sells. Assessee just purchases the asset, he never sells. Provision says it will be capital asset only now. It will be capital asset only now. If he never sells any securities, it will be capital asset only. But if quantum of purchase sale is very high, then AO may think of assuming it as stock in trade. Last is whether assessee has objective to earn dividend or not. See, if assessee has objective of earning dividend, then it is always capital asset. But if objective is just to play with price fluctuation, then it is stock in trade. Sir, AO shall take following things into account before deciding whether it is stock in trade or capital asset. First of all, is AO has to consider all the 4 points that we have mentioned: treatment of books of accounts, holding period, quantum of purchase and sales, and objective to earn dividend or not. AO has to consider these 4 points. Second thing, first of all, if assessee treats such asset as stock in trade himself, assessee himself treats such asset as stock in trade, AO cannot object. AO has to assume, AO has to accept this fact that such assets, such securities are stock in trade. If assessee himself is treating it as PGBP income, why AO will argue? Why AO will argue? It is reasonable enough now. Second thing, if assessee holds any listed securities, if assessee holds any listed securities and that too are held for more than 12 months, AO has to assume that it is a capital asset. Why, sir? Because assessee has an option to sell listed securities. Despite of that option, he is not selling such securities. That means he is holding such assets as capital asset. So AO will not argue unless stance has been changed by the assessee. Unless assessee himself treats us as PGBP, AO will not argue. Despite of all these, if any assessee transfers any unlisted shares, it is normally considered as capital asset only, because normally unlisted shares are not saleable, so it is capital asset only. But sir, if genuineness of the transaction is questionable, if transaction involves any forgery, any fraud, any collusion, any lifting of corporate wheel, sir, in that case, AO may reclassify such sale of unlisted shares as stock in trade also. So reference to valuation officer, you can skip this point. This is not relevant at all. You can skip this point. This is not relevant at all. Sir, for example, if we have two assets like land or building, for example, if I had a land which is acquired way before 10, 20 years it has been, I have that land. And right now I am constructing a building on this. Just 1 year ago, I have just constructed a building on it. Provision says in case you sell such land and building, in case you sell such land and building, you have to understand. You have to understand that whatever the gain on account of land will be long term, and whatever the gain will be on account of building, that will always be short term. Gain on account of land will be long term, gain on account of building shall be short term. There is a difference. Provision says any gain on account of land will be long term, any gain on account of building will be short term. If such building is constructed within 1 year, if such building is short term, then gain will be short term. So how we will split? See, if I am transferring complete land or building for 5 crore, if I am transferring complete land or building for 5 crore, how will I split that? What amount has been received for land? What amount has been received for building? So for that matter, we have to split such consideration on the basis of fair market value. I have to split such consideration in case of fair market value. Sir, I have completed special cases also. Sir, let's again see where do we stand? Where do we stand right now? Where do we stand right now? And sir, where to go? We started off with topic capital gain, where we started off with basic definitions. We started off with basic definitions where we understood what capital asset imply, what transfer imply, what period of holding is, what is rural agriculture land. We continued further to basic computation where we understood how to compute capital gain. We understood the format. We also understood certain special cases, special provisions to be taken care of. For example, we have to take care of sales consideration or full value of consideration in case of immovable property, in case of unlisted shares or any other assets. We have to understand. Sir, how cost of acquisition is determined? Sir, in case of exempt transfer, in case of bonus, in case of right, in case of sweat equity shares, in case of depreciable assets, in case of acquired way ago, in case of demerger, we understood how cost of acquisition is calculated. So then we came on to the topic that is provisos, where we understood how capital gain, how cost of acquisition is to be indexed. What if an NRI or if non-resident invests in India? What if, sir, they sell any bonds or debentures? Whether STT is allowed as deduction or not, we studied all those things in this provisos. After understanding this, we got a basic knowledge of how to compute capital gain. For that matter, we went into advanced topics. We understood how destruction, how capital gain will be calculated in case of destruction. So it will be calculated in the year in which insurance is received. How conversion of capital asset will take place. How compulsory acquisition of capital asset will take place. How JDA will take place. After that, we came on to super advanced topics, which included ULIP taxation, which included slum sale, which included Sir 50 AA, which included DMAT securities, which included advanced money forfeiture. We are still left with these two topics. I think I have to do it tomorrow only, but okay, no issue whatsoever. Sir, after understanding these advanced cases, now if any capital gain arises in our hands, we will be able to calculate. But now we are learning how to save such capital gains. For that matter, we understood exemptions. Once we are done with exemptions, then we came on to tax rates. How such taxes will be charged. Once we claim exemption, we are supposed to tax such capital gain, and how taxes will be charged, we understood. If you are understanding the format, you will understand that our chapter is based on that format only. First of all, understanding sales consideration, then understanding cost of acquisition, then understanding provisions of indexation, then understanding this format in advanced cases. Then after understanding the format, how to save the taxes by exemption. After exemptions, how to calculate taxes, that will be the next part. And at last, sir, some transactions that can never be regarded as transaction, that we need to study. And it is also one of the important topic. So transactions that are not regarded as transfer. Section number 47. Let's come on to the topic that is transactions that are not regarded as transfer. Transaction number 46. See, what this topic is all about. See, certain transaction may appear to look as transfer. For example, if I am giving an asset to you, it appears to be transfer. There are many similar transactions which appear to be transfer, but they have to be exempt. Otherwise, something will go wrong. Otherwise, it would invalidate the act. It would invalidate the intentions of the lawmakers. We call in Hindi, अनर्थ हो जाएगा, अनर्थ हो जाएगा, घोर अपराध हो जाएगा. It will be it will be a violation, big violation. Therefore, for that matter, some transactions, some transfers, despite of falling into the definition of the transfer, will be considered as exempt transfer. Despite of falling into the definition of the transfer, will be considered as exempt transfer. What are those? Distribution of capital asset on total or partial partition of HUF. See, HUF, whenever there is partition happening in HUF. For example, if Mr. A was there, Mr. A had 3 sons. One of the son, Mr. B, got married and started his different HUF. This is called partial partition of HUF. Sir, in case of partial partition, whatever assets, whatever the money that is being given to Mr. B, it is completely exempt. Whatever asset, whatever money that has been given to Mr. B is completely exempt. So we got this point. In case of total partition also, whatever money that unit holders, whatever the money the shareholders get is completely exempt. That will be completely exempt. So transfer of capital asset in case of gift will, what to do in that case? Provision case, understand. If I have any asset, I want to gift it to Arjun. I have to gift it to Arjun. Provision says it is exempt. Any gift given is exempt. Any gift given is exempt. But earlier it was extended to everybody. Right now, any gift given by individual and HUF is only exempt. Any gift given by individual and HF is exempt. Earlier, what used to happen is if anybody used to give, for example, a company is gifting to any other person, it was exempt in the hands of company. But today it is not so. If any person is gifting anything to anybody, only gift by individual or HUF is exempt. Only gift by individual or HUF is exempt. Otherwise, anybody gifting anything to any person shall be taxable. So we got this point. Sir, if any company is transferring any capital asset to 100% subsidiary of such company. If any company is transferring any capital asset to subsidiary of such company, any subsidiary which is 100% subsidiary and Indian company, vice versa, a subsidiary is transferring such assets to the parent company. Parent is transferring to subsidiary or subsidiary is transferring to parent. In both the cases, this is considered as exempt transfer. In both the cases, it is considered as exempt transfer. It is considered as exempt transfer. It is completely considered as exempt transfer. Okay. Okay. I understand this provision. Hmm. The certain conditions to be fulfilled. Provision says you can only transfer capital asset only. You cannot transfer stock in trade. If you start transferring stock in trade, then it is PGBP. It is no capital gain, so no exemption will apply. You have to transfer. You have to transfer stock in capital asset. If you transfer any stock in trade, no exemption will apply. Also, second thing, sir, such parent and subsidiary relationship shall continue for at least 8 years. Such parent subsidiary relationship or parent 100% subsidiary relationship shall continue for at least 8 years from the date of transfer to make that transfer exempt. Also, sir, such subsidiary shall not convert such capital asset into stock in trade at any point of time. Such subsidiary shall not convert such capital asset into stock in trade at any point of time. Okay, so we got this point. Otherwise, sir, exemption claim shall be withdrawn and taxes will be charged in the hands of the transferor in the year in which transfer took place. Are we clear with these three exemptions? Are we clear with these three exemptions? Are we clear with these three exemptions? Oh, yes, sir, we are clear. We are very much clear. Continuing further with the exemptions in case of amalgamation, sir, this is important. This is important. Why it is important, sir? Because not directly, but most of the times indirectly, you might see question from this topic. Sir, what is amalgamation? Where two or more companies form together and form one company. For example, if there was company A and company B together, they form AB, it is amalgamation. If there was company A plus B forms A, it is also amalgamation. If a company A plus B merges and form B, it is also amalgamation. If a company A plus B together forms C, then too is amalgamation. So all these four cases are amalgamation. All these four cases are called amalgamation. So amalgamation can be in the nature of acquisition, amalgamation can be in the nature of merger, amalgamation can be in the nature of anything. Everything is amalgamation as per Income Tax Act. But what condition is, sir, whatever the companies are being amalgamated, their assets and liabilities, their all assets and liabilities should be transferred to new amalgamating company. See, for example, we have a company called Zomato or we have a company called Blinkit. Provision says as soon as Zomato acquires Blinkit, all the assets of Blinkit shall go to Zomato. All the assets of the Blinkit shall go to Zomato. And another important condition for this amalgamation to be valid one is, sir, all the shareholders of Blinkit, at least as a 75% of the shareholder shall continue to be the shareholder in Zomato. Whatever shareholders were in the Blinkit, at least 75% of the shareholders shall continue to be shareholders of Zomato. Then in that case, sir, any transfer on account of this amalgamation Any transfer on account of this amalgamation shall become exempt. Sir, what all transfer become exempt? Let us understand one by one. Understand this. For example, if we had Blinkit, Blinkit was amalgamated with Zomato. Now, Blinkit had certain assets. Blinkit had riders. Blinkit had bikes. Blinkit had many other assets. Blinkit had assets. Blinkit had bikes. Blinkit had goodwill. Blinkit had patent name. Blinkit had cash. So as soon as Blinkit was amalgamated with Zomato, every asset of Blinkit became the asset of Zomato. So there was transfer of asset. Provision says transfer of asset by the amalgamating company to amalgamated company. Sir, it shall be exempt transfer. In this case, sir, amalgamating company is Blinkit. Amalgamated company is nothing but Zomato. So just think of a person like Rahul. Rahul had shares of Blinkit. Rahul had shares of Blinkit. Forcefully, my shares of Blinkit were taken. Shares of Blinkit were taken and return. I was given the shares of Zomato. 75%. 75%. Forcefully, my shares were taken from the Blinkit and now I was given the shares of Zomato. Forcefully. How could you do this to me? Provision कहता है, provision says. Lakshmi, I have shared my Telegram channel. Just message me on Telegram. I'll talk to team. How can they say this? I'll talk to team. Need not to worry. Message me on your number on Telegram channel. I will talk to team. Message me. My Telegram channel link is in the description. Just message me on Telegram. I'll talk to team. I just want your number. Team will call you and team will tell every detail properly. Need not to worry. Okay. Sir, if I had shares of Blinkit, if I had shares of Blinkit and those shares were compulsorily taken, sir, shouldn't this be transfer? Right answer is yes, there should be transfer. It should be transfer, but that will be exempt transfer. See, surrender of shares by shareholders of amalgamating companies. Sir, amalgamating company shareholders surrendering their shares, sir, to get the shares of these shares of the amalgamating company. In this case, consideration should be this transfer should be exempt transfer. Meanwhile, just listen to these provisions and Lakshmi. Okay. Sir, this is a typical case. This is a typical case. I just want your attention for just 1 minute. I just want your attention for a minute, just 1 minute. Listen to this and you will understand everything. You will understand everything. Let's just listen to this. For example, this we have a company called Geo. Reliance Jio. You must have heard the name. You must have heard the name. Geo's parent company is Reliance. Sorry, Geo's parent company is Reliance, but sir, 10% of Geo are being held by Facebook. 10% of the shares of Geo are being held by Facebook. Okay. Provision says, sir, what if this Facebook amalgamates with Meta? Amalgamates with Meta. Facebook is amalgamating with Meta. Isn't it the case where shareholder was Facebook, now shareholder has become Meta? Earlier, whatever the shares were held by Facebook now are being held by Meta because Facebook merged into Meta. Isn't it the case? Isn't it the case? Shouldn't this be transfer? Shouldn't this be transfer? Because ultimately, Facebook was the shareholder. Facebook was the shareholder. Now Meta has become the shareholder. Shares are being transferred from Facebook to Meta. Shouldn't this be transfer? Provision says yes, it will be transfer, but it will be exempt transfer under Section 47. It will be exempt transfer. Exempt transfer. Oh my God. Oh my God. Oh my God. Oh my God. Hmm. At last, if any capital assets are being transferred in case of banking company with banking institution. Sir, for example, Union Bank merged with Vijaya Bank merged with Union Bank, any transfer of capital asset shall become exempt transfer. If such amalgamation is on account of Banking Regulation Act, then it should be exempt. These were the exempt transfer in case of amalgamation. Now, sir, demerger. Sir, what is a demerger? See, for example, we have a company called Reliance, out of which, sir, Geo Financial Services emerges. Sir, in this case, Reliance is called demerged entity, and the Geo Financial Services is called resulting entity. Demerged entity from which demerger take place, resulting entity which comes into existence after demerger. Provision says, sir, whatever the asset, all the assets of the undertaking transferred by the demerged company become assets liabilities of the resulting company. Whatever the asset that Reliance gives shall become part of the Geo Financial Services. No asset should be sold outside also. Sir, all the assets should be transferred at book value. But sir, if Geo Financial Services hold Ind AS, then this may be recorded as fair market value. See, normally at the time of demerger, such shares are transferred at book value. But if Geo Financial Services follow Ind AS, then in that case, it can still record these shares at fair market value. Sir, shareholders, see, for example, if I have shares of Reliance, for example, one share, and I am getting, if Geo Financial Services demerges with Reliance, then I should be getting shares of Geo Financial Services in the same proportion as I had shares of Reliance. Also, such shareholders of holding minimum 75% of the shares in the demerged company shall become shareholders in resulting company. Provision says whatever the shareholders were, at least 75% of the shareholders shall continue to hold in a demerged company. Also, sir, demerger should take place on the going concern basis. This should be taken on the going concern basis. In that case, some certain transfer will become exempt transfer. Sir, what are those? Example. For example, Reliance is there, and Geo Financial Services emerges out of Reliance. So, sir, many of the capital assets are being transferred from Reliance to JFS. In this case, any transfer will be exempt transfer. Any transfer of capital assets from Reliance to Geo Financial Services will be exempt transfer. Okay, sir. Surrender of shares by the shareholders of the demerged company for receiving the shares of the resulting company. What it implies? Just understand this. For example, Reliance is a company which had 1,000 crore net assets. 1,000 crore worth net assets. Out of this, 900 crore went to Geo Financial Services. 900 crore went to Geo Financial Services. Rahul was a shareholder holding one share, acquired at the rate 1500. Now, since 90% of the assets went to Geo Financial Services, I got a share for free, share of JFS for free. Provision says as soon as I got share for free, my Reliance share price will fall by 90% because 90% of assets are transferred. So share price will fall by 90%. My share price will become 150 and value of share of JFS will become 1350. Sir, don't you think I have lost too much of value? Don't you think I have lost too much of value? Earlier, I used to have 10 times voting power. Earlier, I used to have 10 times power. Now my power is being reduced to by 90%. Earlier, I used to have power in 1,000 crore assets, but now I have power only in 100 crore assets. Sir, whatever the surrender of power, surrender of shares that shareholders of demerged company do for receiving shares of resulting company, this is exempt transfer. Sir, no capital gain will arise in this case. Earlier, AO used to tax these transactions, but provision clearly states that no capital gain will arise. Okay, sir, we got this point. Another very classic example. Sir, for example, shares of Geo are being held by Meta. 10% of the shares of the Geo are being held by Meta. Out of this Meta, a company emerges called FacePad. FacePad, a company emerges, and some of the assets are being transferred by Meta to FacePad. There happens to be a demerger. In this demerger, many assets from Meta are being transferred to face pad. Many assets from the meta are being transferred to face pad. In this case, what provision says? In this case, what provision says? Provision says if shares of Geo are being transferred by Meta to FacePad in case of demerger, provision says this is also exempt transfer. This is also exempt transfer. Need not to stress this point much, but we can reasonably conclude that this is also exempt transfer. Okay, so we got this point. We got this point to the fullest. Sir, if there happens to be redemption of sovereign gold bonds, if there happens to be redemption of sovereign gold bonds, so that is always exempt transfer. If there happens to be redemption of sovereign gold bonds, it is exempt transfer. It is exempt transfer. Sir, but this is exempt only for individual HUF. For any other person who subscribes to sovereign gold bond, it will not be exempt transfer. It is exempt for only individual and HUF. It is exempt for only individual and HUF. We got this point. Okay, sir, got this point. Sir, if I transfer any asset under reverse mortgage scheme, then it will be exempt transfer. Sir, what is this reverse mortgage scheme? Understand this. What happens is, see, if I am very old, if I'm very old, 70 years of age, no money, no child in India, everybody is living abroad. I am just living alone on this stick, on this stick, on this stick. This stick is the only support to me. I have no money, no family members. What to do? What to do? What do I do? But sir, I have a house. I have a house. What will I do of this house? What will I do of this house? If I die, what will I do of this house? I want to live now. Even if I am 70, I want to live my life. And if I don't have money, what will I do of this house? Provision says you have an option. You can reverse mortgage your house to bank. Sir, what is this reverse mortgage? Sir, you can enter into when you can enter into an agreement with the bank that as soon as you die, you can transfer this house will become property of the bank. This house will become property of the bank. Till then, bank is required to give you every month payment. Bank is required to give you every month payment. It is a kind of reverse mortgage scheme. Ultimately, sir, you are not paying EMI, but you are receiving EMI for every month. Okay. So what happens is, sir, the house will become property of the bank after the person dies. In return, bank pays every month payment to the owner. Every month payment to the owner. Simple provision it is. Sir, important point is, if I am transferring this asset to bank, it is exempt transfer in my hands. It is completely exempt transfer in my hands. Also, whatever money I am receiving in return, that is also exempt. And sir, later on, bank, whenever selling this asset, will have to pay capital gain. Otherwise, it is no capital gain lies in the hands of such old person, such person who transfer any assets in a reverse mortgage scheme. Sir, if I transfer assets as per SEBI guidelines, any shares under stock lending scheme. So what is stock lending scheme? What is stock lending scheme? See, if I don't have any shares, but I just want to short sell them. I just want to short sell them, and not just for one day. I just want to short sell them for 2 or 3 days. I can borrow shares, sell them, and later on I can buy them when they are at lower price. But I can sell them at current price, and I can buy them when they are at low price. For that matter, I have to borrow shares. Provision says if I am borrowing shares, this shall not amount to transfer. So any shares if are being borrowed shall not amount to transfer. Okay, so we got this point. Sir, if any predecessor cooperative bank, you can skip this point. You can skip this point. There is least chance that the question may be asked from this point. You can skip this point. Sir, consolidation of mutual funds. Sir, understand this point. For example, if we have any kind of mutual fund, sir, if we have equity oriented mutual fund consolidating with other equity oriented mutual fund, then whatever gain on consolidation will take place will be an exempt transfer. No capital gain will arise in case of such consolidation. Similarly, sir, if a debt-oriented mutual fund consolidates with debt-oriented mutual fund, sir, because of synergy benefit, whatever benefit I am getting will be exempt transfer. But remember, sir, if an equity-oriented mutual fund merges with debt-oriented mutual fund, sir, no synergy benefit, no exempt transfer. It will be taxable. It will be taxable. Sir, for example, if I have Nippon equity classic fund. Nippon Equity Classic Fund acquired at the rate of rupees 100,000 units. Cost of acquisition was 1 lakh. Now, sir, Nippon Equity Classic Fund merges with Nippon Equity Growth Fund, and I have been allotted 1200 units of 90 each. Then in that case, I had acquired units worth rupees 1 lakh. In return, in case of unconsolidation, I am receiving units worth rupees 1 lakh 8,000. Whatever benefit that I am getting 8,000 rupees, sir, this is exempt transfer. This is exempt transfer, sir. This will not be treated as transfer. Sir, whenever I'll be selling these units, then net capital gain will be considered. Net capital gain will be considered. Similar provision applies to, sir, if one of the fund is consolidated with another plan, one of the plan is consolidated with another plan. For example, if I have Nippon India dividend plan. Similarly, we have Nippon India growth plan. If sir dividend plan merges with growth plan, then that too amounts to no transfer, so no transfer will take place. So listen to very special provision, and so this is the area which has been asked multiple number of times in exam. This is the area which has been asked multiple number of times. So this has been asked in May 25. This has been asked in MTP second MTP that was just asked yesterday. Yesterday only ICI released the second MTP, and again same question was asked. Again same question was asked. I should not say same, but similar question has been asked. So what this question is all about, just listen to this. And as soon as we are done with this topic, we'll be done with complete capital gain except for those two special cases. Otherwise, we are done with the chapter. Understand this point. Sir, if any proprietorship converts himself, if any proprietor converts himself to a company, or a partnership firm converts itself to a company, or a association of person like AOP converts itself to a recognized stock exchange, there is going to be too much of asset transfer, too much of shares transfer. Many things are going to happen. Provision says it will be considered as exempt transfer. It will be considered as exempt transfer. If any, if any, if any proprietor converts into company, partnership firm converts into company, or any AOP converts into recognized stock exchange, in all the three cases, any transfer of capital asset shall become exempt transfer. Any capital gain arising shall be exempt, provided certain conditions are being fulfilled. What are those conditions? Listen. Sir, all the assets and liabilities of the entity are transferred to the company. For example, if I am proprietor, whatever assets I have as a proprietorship firm, all such assets should be transferred to company. All such assets should be transferred. Second thing, consideration received to the proprietor partner shall be only shares of the converted company. If I am the proprietor and I am transferring all my assets to the company, in return I should not be getting any money. I should not be getting any money in return. Rather, I should be only getting shares. I should be only getting shares of such company, no other consideration. Sir, also, as a proprietor, I should be the only one getting the shares. As a partnership firm, whatever the partners were, shall be getting the shares. As a proprietor, I should be getting the 100% shares. As a partnership firm, partners should be getting the shares on the basis of outstanding capital on the rate of conversion. Whatever the outstanding capital were on the rate of conversion, that should be the proportion in which share capital has to be attributed. Shares should be allotted. Are we clear with this fact? First of all assets should be transferred, and I should be getting, proprietor and partner should be getting only shares, nothing else in consideration. So proprietor should be getting 100% shares and partner should be getting shares in the ratio of their outstanding capital. Also important point is, sir, shareholding of previous proprietor. Sir, what happens is, as soon as I am allotted shares, I'm a proprietor, I am being allotted 100% share. Provision says that I can sell these assets, but till the end of fifth year, my shareholding shall not be less than 50%. Shall not be less than 50%. I can sell some of my shares. I can sell some of my shares, but remember, my shareholding shall not be less than 50% till the end of the fifth year. I can sell 1%. I can sell 2%. I can sell 20%. I can sell 40%. I can even sell 49%. I can even sell 50%. But my shareholding shall not be less than 50% till the end of the fifth year. Till the end of the fifth year, my shareholding should be at least 50%. Are we clear on this fact? Yes, sir. We are absolutely clear on this fact. Absolutely clear. Similarly, for partnership firm, whatever the partners are being allotted shares, their shareholding shall not reduce to less than 50% in 5 years. At least for 5 years, they should continue to hold shares. Sir, also, if any corporatization of stock exchange takes place, that should be accordance with the SEBI guidelines. See, if AOP converts into stock and trade, that AOP converts into stock exchange. In that case, whatever the conversions takes place, that should be as per SEBI guidelines. That should be as per SEBI guidelines. Sir, important segment. If a public company converts into LLP, if a public company converts into LLP, how transfer will be exempt, how transaction will be exempt, we need to understand. So first of all, can every company convert into LLP? Right answer is no. Can every company convert? Right answer is no, sir. Only unlisted public company or unlisted private company. Unlisted company can be converted into LLP. Only unlisted company can convert. And that too, fulfilling two conditions. Both of the conditions should be fulfilled, so that only a company can convert into LLP. Sir, what are those conditions? Sir, provision says. Sir, check the date of conversion. Prior to date of conversion, we have to check 3 years. In any of the 3 years, sir, gross assets should not exceed 60 lakh rupees. Prior to date of conversion, for all the three preceding years, such company shall not have gross asset exceeding 20 lakh, 60 lakh rupees. Yani for every year, gross asset should be less than 60 lakh rupees if it wants to convert into NL. So gross asset for any year shall not be exceed 60 lakh rupees prior to 3 years, 3 years prior to the year of conversion. Also, sir, prior to date of conversion, sir, my total asset at any point of time shall not be more than 5 crore. My total asset at any point of time shall not be more than 5 crore. At any point of time shall not be more than 5 crore. In that case. In that case, sir, my unlisted company is eligible to be converted into LLP. My unlisted company is eligible to be converted into LLP. Sir, but things to be taken care of. Things that are to be taken care of. Sir, all assets and liabilities should be transferred to LLP. Oh my God. Oh my God, sir. All assets and liabilities are to be transferred to LLP. Oh wow, sir. That means whatever the assets and liabilities are with the company are to be given to LLP. Second thing, all the shareholders of the company shall become partners, and their capital contribution and PSR are in the proportion of the shareholding. Whatever the shareholding is, so that shareholding should be used as a basis for determining the partner's capital. That shareholding shall become the basis of determining the profit sharing ratio. Sir, whatever the consideration shareholders are getting is only the PSR of the capital, PSR and capital. See, shareholders shall not get any cash. If company is being converted into LLP, shareholders should not get any cash. Rather, they should be only given the share of profit. They should be only given a share of profit. So this is a beautiful point. This is a beautiful point, sir. No, acha. Total profit sharing ratio in shareholding shall not be less than 50% up to 5 years from the date of conversion. See, date of conversion, whatever shareholders were 100%, they are being allotted 100% profit sharing ratio. Provision says this profit sharing ratio can be reduced. This profit sharing ratio with these partners can be reduced, but maximum, sir, 50%. If it is less than 50%, then in that case, sir, this conversion will become invalid conversion. They can have some additions, they can have some additional partners, they can have some partners can retire, some partner can die, but the PSR that was with the original shareholders, that should at least continue to be 50% and up and until 5 years from the date of conversion. For 5 years, such shareholders in the company shall continue to be the partners, at least holding 50% of the profits. Okay, sir, we got this point. Last and the most beautiful provision of this topic, most beautiful provision is, sir, if there was company, if it were company had reserves, if assessee were to take out the reserves, then it was mandatory for him to declare dividend. Apart from declaring dividend, you cannot take out reserves of the company. In any case, you cannot take out. In any case, you cannot take out. If you want to take out the if you want to take out the money from the company, if you want to use the reserves, you want to use the reserves for the benefit of the shareholders, so you cannot use it. You have to declare dividend. Then only you can take out the reserves. But there is issue with the dividend. If you declare dividend, then it will be taxable in the hands of shareholder again, and there will be double taxation. What to do, sir? They planned out of converting into LLP. What people did is people planned out converting company into LLP. Now, what will happen, sir? These reserves are free to be taken by the partners. Reserves can be freely taken by partners. Are you seeing the tax planning, the beautiful tax planning that people did? Beautiful tax planning that people did. See, as a company, you cannot use the reserves, but as soon as you convert into LLP, you can use the reserves. What a beautiful tax planning, sir. Government, if you think you are bad, then government is your dad. If you think you are bad, then government is your dad. What it says. No amount should be paid directly, indirectly to the partners from the accumulated reserves standing on the date of the conversion. Sir, whatever the accumulated balance is on the date of conversion, that should not be taken by the partners. That should not be taken by the partners, and if partner take out that profit, that shall be considered as dividend only. That shall be taxable in the hands of the partners under income from other sources. Oh my god, oh my god, how depth provisions can be. This is what tells, these provisions tell us how in-depth provisions can be, and with this batch we are aiming to cover those provisions on. Okay, so provision says if any of the condition is violated, then the successor entity has to pay the taxes. So, for example, proprietor converted into company and company violated the condition. For example, company's shareholding reduced to less than 50%. Then in that case, that company has to pay the taxes, whatever were applicable. Sir, exempt transfer in case of conversion of securities. For example, if I have debentures and that debentures are being converted into shares, if I have deposit certificate, those deposit certificates are being converted into shares. If I have any preference shares, are being converted into shares of shares of company. If I have any physical gold that is being converted into digital gold, sir, all these will be considered as exempt transfer. Sir, we have exempt transfer in case of non-resident taxation. We have to keep this topic on hold. We'll study this after non-resident taxation. Sir, I want you all to answer a few questions. I want to answer. I want you all to answer a few questions. Just answer it one by one. Just answer it one by one. Please, all of you cooperate, because this is not that topic that I want to waste. This is really an important topic. Sir, for example, Rahul acquired property at rupees 10 lakh on 1st April 2001. I gifted this property to my sister Anu. She is my sister Anu on 1st April 2012. There was a time, 1st April 2006, I had done some improvement worth rupees 5 lakh. Again, later on 1st April 2016, Anu did certain improvements. Anu did some certain improvements worth rupees 7 lakhs. After all, on 1st April 2024, Anu sold such property to Mr. Mohit. My question to all of you is, sir, if Anu is selling this property, what will be the cost of acquisition in the hands of Anu? What will be the cost of acquisition in the hands of Anu? I don't want to know the cost of improvement. I want to know the cost of acquisition. I want to know the cost of acquisition. What will be the cost of acquisition in the hands of Anu? I'm literally telling who will not answer is doing something wrong with himself. You should answer. You should answer. Sir, what will be the cost of acquisition for the Anu? What will be the cost of acquisition for Anu? Sir, if any asset is received on account of exempt transfer, if any asset is received on account of exempt transfer, then wow, 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 nice. Sir, if any asset is being received on account of exempt transfer, sir, cost of acquisition shall be taken as cost of acquisition of previous owner. Cost of acquisition will be 10 lakh. At right now, I did not ask for indexation. I did not ask for indexation, but I just wanted to know the cost of acquisition, and you said it correct. So the cost of acquisition will be 10 lakh. Are we clear with this fact that whenever any asset is being received on account of exempt transfer, cost of acquisition shall be taken from the cost of acquisition of previous owner? Cost of acquisition shall be considered as cost of acquisition of the previous owner. Sir, very simple point it is. So simple. Sir, what will be the cost of improvement? I want to know. Do not index it. Do not index it. Sir, what will be the cost of improvement that shall be considered, sir, for Anu? What will be the cost of improvement? Sir, will it be only 3 lakh? Will it be only 7 lakh? Or will it be 7 lakh plus 12 lakh? Will it be only 3 lakh or will it be 3 lakh plus 7 lakh? The 12 lakh? Yes. Yes, yes, yes. This point is literally very clear. Sir, since cost of acquisition has been taken from the previous owner, cost of improvement will also be taken of ourselves. Cost of acquisition will also be taken for ourselves, and previous owner's cost of acquisition will also be considered. Yes, sir, it is very much clear. So cost of improvement will be 12 lakh. Very simple point it is. My third question is, sir, what will be the period of holding for Anu? Should this period of holding be from 2012 to 2024, or should this be period of holding from 1 to 2024? What will be the period of holding in the hands of Anu? What will be the period of holding for Miss Anu? Sir, will it be 12 years or will it be 24 years? What will be the period of holding for Miss Anu? Will it be 12 years from the date she acquired the property, or will it be 24 years from the date on which his brother acquired the property? Right answer is yes. So 24 years, because whenever any asset is being received, whenever any asset is being received on account of exempt transfer, then in that case, cost of acquisition of period of holding of previous owner is also considered. Cost of acquisition of previous owner is also considered. Yes, sir, we got this point. So now, last question for the day. Last question for the day, and we'll be done by this. Sir, if I am asked to index it, if I am asked to do indexation of this point, sir, cost of acquisition will be taken 10 lakh. Multiply will be done with the CII of year of transfer, that is 363. Sir, divide, what division we'll do? CII of 0102, that is the cost of acquisition of previous owner, or we will do CII of 1213, that is the year in which Anu acquired the property. So from when we are going to index? Are we going to index from the date from which Anu acquired his property, or are we going to index from the date from which his brother acquired the property? That is what the last question of the day is, and I want answer from all of you. I want answer from all of you. So from what date we are going to index? So previous year 1 2 or previous year 12 13? From her brother's acquisition. Arjun says this, but sir, What but, sir? Not but, sir. Sir, similar view is expressed in case of Manjula Jesha, Manjula Jesha at Bombay High Court. And this is logical also. This is most logical. This is logical now, since we are considering the cost of acquisition of previous owner. We are considering improvement also for the previous owner. For period of holding also, we are considering the previous owner also. For why not for indexation? Why not for indexation? And same view has been expressed by Bombay High Court in case of Manjula Jesha. But sir, if you read Act properly, if you read Act properly, so indexation is always done from the acquisition date. So most of the cases ICI has solved from this date. ICI, whenever you will see answers of ICI, they have solved it from this date. They have done indexation from the year of acquisition of such second person, of such of Anu. In case of acquisition of Anu, they have done the indexation. But sir, we have a plus point in this case. We have a positive point in this case, because for every answer for which they have done indexation from here, they have given an alternate answer where they have expressed a view that answer could have been done from this date also. So we are not going to follow this step. We are always going to follow this step. We are always going to follow this step. That means indexation will always be done from the previous owner. So at any point of time you find out a solution where indexation is done from the current owner, you can ignore that solution, because in suggested answer you will find another alternative answer which will definitely state that indexation can be done from previous owner. Dear friends, with that we complete our capital gain chapter, right away starting from definitions, continuing further with basics, continuing further with special considerations, continuing further with advanced cases, continuing further with exemptions, continuing further with tax rates, continuing further with the exempt transfers. Holistically, we completed the complete capital gain chapter. We are only left with two topics, that is transfer of assets from partnership firm to partner and a capital gain in case of liquidation, that we are going to study tomorrow. Along with that, we will study question answers also. We will do important questions tomorrow only. In first half, we'll be able to complete capital gain. And in first half only, we'll start with income from other sources. Also, we'll be able to complete IFOS tomorrow, and we can move to PGBP tomorrow itself. You all have been wonderful, wonderful students. In case you have any doubt in any topic of this TT, you can ask me in the Telegram channel. Telegram number I have given. You can ask me at any point of time. Also, now you are in a position to solve every question of capital gains. So you can try solving questions of your own. Okay, good. Good point. Okay. Sir, now you can solve any questions. Now you can solve the complete questions of this chapter. Every question you can solve right now. From this capital gains chapter, you can solve any question. It is as simple as it can be. You can solve any question. Sir, I am giving you a daily practice question. If you are following my question bank, just give me a second. If you are following my question bank, or if you are not following my question bank, if you are following my super 100 question, if you are following my super 100 question, then there is a question starting with Mr. Sanjay. Question number 8, Mr. Sanjay. Question number 8, Mr. Sanjay, of super 100 questions. I am just jotting it down. Daily practice question number 1. Question number 8 of super 100. Capital gain, Mr. Sanjay. Sir, what is this DPQ? You have to write it down as if you would have written this question in exam. You have to send the solution, your handwritten solution, in my Telegram number. I will see that answer. I will evaluate whether you have done it correct or not. I will tell you what improvements you can make to get better marks. I will tell you where you went wrong. You have to solve this question. If you want the PDF of the Super 100, it is already uploaded on my Telegram channel. You can definitely access that. Apart from all of this, so one thing I want from you all, sir, if you want to enroll for this batch, do think of enrolling it as soon as possible, because sir, as soon as you enroll, you will get the serial key to that batch and you will be able to access the batch without any issue. See, only limited number of classes are going to be on YouTube. It is possibly 4 or 5 classes will be on YouTube. Apart from that, this batch will be on app only. So for that matter, if you are enrolling, if you are thinking of enrolling, do enroll it as soon as possible so that key is provided to you as soon as possible. Also, to be very honest, if you are loving this batch or if you are liking this batch even by this much, do consider recommending it to your friends, because it takes real efforts to speak English this much for a person like me who does not even know how to speak English. I am not very fluent at English, but I am trying. I am really, really trying, because you are trying. You are trying to work hard, so I am there just to support you. If I am, if I am able to try this hard, why not you? And if I am trying this hard, why not other people also take benefit of this? So if you have any friend who is looking for classes, who does not understand Hindi, can definitely come to this batch. Also, sir, also, one thing, sir. Even if anybody joins this batch at 20th I guess 15th lecture or 12th lecture, he can come live. It is not necessary there. Every session is an entry point. Every session in this batch is an entry point. Every day, if you have not studied previous classes, you can come. Do not think it that way, that we have not studied yesterday's class, I may or may not be able to come. Every time you can come. Every time you can come. At any day you can come. Okay. So every day is an entry point, any day you want to come live, you can come live. Do not think as if that we have not studied yesterday, we will be able to understand or not. You will be able to understand every day. So there is no issue whatsoever. Paki, thank you so much for coming. You all have been wonderful students. And it's indeed pleasure. It is indeed pleasure to teach such a beautiful community of South India. So I am feeling honorable to be contributing very small to your efforts. Also, this year I will be coming up with super 100 questions in English. Also, I will try to upload it in recorded version. I will definitely come up with English super 100 questions. Yes, I will definitely come up. Chinu, for sure I'll do it. For sure I'll do it. This time I'm committing. I will definitely deliver. I'll try to do it before 15th. I'll try to do it before 15th. I'll do it. Okay, Chinu. See you soon. It was a great session. Thank you, sir. You're most welcome. You're most welcome. Bye bye. Take care and enjoy studying. Many thanks for watching. See you tomorrow live with same energy, excitement, enthusiasm. Signing off. See Rahul Satija.